Welcome to what will be a joint live stream of us going through the Fed FOMC press release, rate hike decision, and the Q&A with Jerome Powell. And then right after that, we'll go into the HouseHack Q&A. We're doing that because today is the deadline to sign up to invest in HouseHack. If you're interested, as an accredited investor, you can sign up at househack.com/2024, read the prospectus, read the solicitation there, and you only have to sign your subscription agreement today. You can get your accredited investor letter and your funds in after today. But the most important deadline is signing today, so stay tuned for that. But anyway, let's focus today on the Fed. Fed J-Pow. Oh dear. So this is obviously going to be a pretty big day, mostly because this is expected to be the first meeting that Jerome Powell is actually going to respond to the fact that inflation hasn't actually been as consistently down as it was in the second half of 2023 for the first 3 months of this year. We're starting to see job numbers start coming in lower, like, for example, the JOLTS readings or infotech workers, that is, tech and finance bros not having as many opportunities for jobs. However, you're still seeing job changer pay higher than expected, ECI higher than expected. You've got, obviously 3 in a row hotter inflation reports to some level or another, core inflation moving up. There are quite a few problems that you're running into. So obviously today we are going to explore what J-Pow has to say. We'll obviously be doing some bingo as well. Let's go ahead and put a little banner up here and make sure we've got all our sources going. Let's see. We'll be covering this live from multiple angles. The press release is in about 10 minutes. Let's listen in here for just a moment. There it is, Fed decision.
The change at this meeting, they've been focused on things like the overnight reverse repo facility, and that actually has risen recently. So we're not close to reserve scarcity at the moment. The second thing is I would be concerned about easing financial conditions in this environment. And if the only kind of decision that comes out of this meeting is a slowing in the pace of QT, I think that's a problem from the Fed's perspective. And so I see very little downside for delaying to June, doing it at a time where they can pair it with a more hawkish leaning dot plot. And so our baseline is that happens. But I would agree. I think it's very easy to see that they actually do slow the pace of QT today.
Hey, Matt, good to hear from you. Matt Lazzetti at Deutsche Bank going into this decision 10 minutes away. That final comment there, Bramo, you've said that repeatedly over the last few weeks.
Is there a concern that they send one message that's more dovish than they'd like by saying, we want to end some of the quantitative tightening? At the same time, why not go ahead with this? Because they can walk and chew gum at the same time, evidently.
Let's get to Kathy Jones of Charles Schwab. Kathy, Bob Michael's with us, and he mentioned the statement. If we can just go to the first paragraph of the previous statement, there's 2 lines in it Bob mentioned. Recent indicators suggest that economic activity has been expanding at a solid pace. They say this on inflation. Inflation has eased over the past year, but remains elevated. When we open this statement up in about 9 minutes' time, Kathy, are you expecting that opening paragraph to get a heavy edit?
Well, I think there'll be some edit to it. I think you could still describe the economy expanding at a solid pace, because solid means it's expanding, right? And we did get, 3.1% growth in the first quarter in domestic demand. So I think that can be the same statement. As for the signaling on inflation and where we're going from here, I think that's where we're probably going to see the changes to the statement. I mean, it's very hard to parse through this ahead of time, but I would guess that it does get a heavy edit in the second sentence.
The markets are moving, Kathy, and we've got a 2.29, almost 2.30% 10-year real yield. I'm sorry, that changes everything for American business. Does the Fed cognizant of that? Are they aware of a real yield running away?
Oh, I'm sure they are, and I'm sure that they would have thought that elevated real yields at this stage of the game had probably slowed the economy more than it has.
Well, especially in real estate, the lag that the Fed is seeing in rates actually affecting real estate has really been sort of bothering the Fed, because they've been waiting for this housing disinflation to drive rents down faster. And the problem is market rents, new rents are coming down, especially in what I look at as overbuilt areas after the COVID boom. What you're finding is a lot of tenants are sort of stuck in higher rents because they don't want to move, and their landlords aren't actually reducing their rent. So you have this sort of duality of an issue where, yeah, market rents are lower, but actual rents that people are realizing are still lagging high because even though rent increases can happen while you're still living there because your landlord just raises your rent. Usually rent reductions don't happen until you actually move and realize and pick up a lower rent. So that's unfortunate. That makes it a little bit harder to get that inflation data down, which is frankly something we've been waiting for a very long time. Been waiting for those rents to come down, and we just haven't seen it on the owner's equivalent section. Now, I know a lot of people say, oh, well, Kevin, they're just using lagging data. Yes. Yeah, they are using lagging data. They're not using market data, but they're purposefully using this lagging data because they want to capture people who are in leases, not just new lease signers. And so the lag is there for a reason. Don't get me wrong. I'm not here to defend the reporting of the government. I think there are plenty of flaws in it, but I also understand this point of view that I think others ignore. And the risk of that is, if you ignore this, it makes you think that, oh, yeah, okay, well, rates should come down a lot faster because of what's going on with market rents. And the reality is just different from the expectation. So we'll see how things move here. Obviously, my personal opinion is that we're expecting a J. Powell. He'll be out in about 35 minutes. We'll get his statement out in about 5 minutes. So one of the things to keep in mind is the statement. The only two things we're really expecting are a confirmation that rates are staying the same. There's less than a 1% chance they're going to, rug us or shock us with either a rate cut or rate hike. To me, that's not something that I'm sort of planning on when it comes to trading, but I would consider some trading based on how hawkish or dovish his tilt is today. So obviously there's some big movers, especially in the AI space. Intraday here, we're down 4% on ARM, 4% on NVIDIA. SMCI beat across the board, but the darn thing is actually down 17 or 18%. Bitcoin's moving right. Look at it move right to this resistance line at this point that we have here. It's about 57. Let's see if I can get the actual number here. It's about 57.5-ish. Looks like we're trying to break through it right now. Yeah, there it is. I have it at 57.560. That's where I have this. We've dropped all the way down to about 56.5 earlier today, sort of almost in anticipation of the Fed potentially, or as a result of some of these sales in AI and some liquidations as a result of maybe too much leverage, or the enthusiasm of the halving and the Hong Kong ETF catalyst now being behind us, leaving people taking some of their cash and deploying it into where they think sort of the next momentum move might be. Who knows? So we'll take a peek at that. We'll be watching that obviously as we go through this. Now remember that the next thing we're expecting from the Fed would be potentially a $30 billion a month slowdown in how quickly we are tightening the balance sheet runoff over at the Fed. Basically, that means you're flooding the market with treasuries less than you've been flooding the market with treasuries before. So you're putting $30 billion fewer of treasuries into the market, and that means you have less supply. So less supply could drive the price up of bonds, which would drive the yield down. So we could get a reaction to the downside for yields if we do end up getting the reduction of the taper. I don't know if we will, but we could. In which case, some folks are saying that TMF is at a bottom. Now's the time. And so here's what TMF looks like right now. It's sitting at about 44.8. A lot of folks looking at this going, once we get a reduction in the taper and we get a dovish Powell, we're going to say yields come down maybe 10, 20 basis points, and that's going to start this potential TMF rally. So that'd be something to pay attention to. Yeah. Somebody here. Thank you very much for using the proper terms of the words fewer and less. There's always a grammarian somewhere. Who's seen Grammar Nazi? That's a funny little clip on YouTube. But what does it call it? College humor. I think put that together. That was a good one. Grammar is very important. Anyway, we are now 2 minutes away here from a J. Powell meeting. Right now, we've got a bunch of staff in both the investor relations email and the staff email. So if you have questions for us, you could email us at ir@househack.com for HouseHack. We'll be doing, obviously, the Q&A a little bit later. And then we also have the, what's it called? Oh, good Lord. We have staff in the staff email. If you have questions on the courses on building your wealth, we've got a lot of emails that have come in this morning. Some folks are asking for BNPL, so we briefly have Pay in 4 for PayPal and BNPL on for some of the folks who are looking for that as we're processing through some of those emails before we raise the price. So we just want to get through all the emails of the people who emailed us last night. We got in at like 1:30 at night, so it's been a little rougher. Anyway, okay, so let's get ready here for Fed J-Pow Day. Fed J-Pow statement gets released in about 1 minute here. So after this release of the statement, we are going to live stream J-Pow doing Q&A, and obviously we'll add commentary and we'll be doing bingo as necessary. So we're now 1 minute away. Time to probably get a little bit of that countdown music. Can we do it? Who wants to be a millionaire? It's always my favorite to get that going. So let's see. Ooh, do I have it handy? Phone a friend? We need the phone a friend. Phone a friend. That's what we need. And so we're about 30 seconds away from that statement coming out. What I'll do is I'll read the sort of wire release first, and then we'll actually get to the PDF. Here we go. Let's get the cues. All right, all right. All right, all right, all right. All ready? Here we go. Fed vote was unanimous. Federal Reserve leaves overnight unchanged. Will slow its balance sheet by, let's see, redemption cap to $25 billion per month from $60. Whoa, they went with 35 of a taper, $35 billion fewer, basically. And so we're going to maintain mortgage-backed securities at a cap of 35. And we're going to slow the decline of balance sheet runoff by cutting the cap to 25 billion. We were thinking they were going to go down to 30 billies. Inflation has eased over the past a year, but remains elevated. So this is actually even more of the opposite of taper, as much as that makes sense. The opposite of taper is somewhat of an easing, right? And this is actually more easing than we were expecting by about 5 billion. So that's actually slightly dovish, right? That's more dovish than it is hawkish, without a doubt. Inflation has eased over the past year, but remains elevated. Economic activity continues to expand at a solid pace. Job gains have remained strong. Unemployment has remained low. Fed says achieving employment inflation goals have moved towards better balance. That's the same thing we've heard many times before. Fed vote was unanimous. And let's see here. Economic activity continues to expand at a solid pace. We got that same sort of line there. Risks of achieving, better balance. Not expected to be appropriate to cut rates until it has greater confidence inflation is moving sustainably towards 2%. So really no change to that statement other than the fact that we just got more of a reduction in the Treasury's runoff than we were expecting. So that's dovish. That leans dovish today. So we'll see how Jerome Powell's commentary matches that. Right now, as you can see, the Q's got a little bit of a green candle here. Not a really big movement because you still have that potential J-Pow to the face. That J-Pow to the face is coming out in about 29 minutes. But I will say this feels more dovish already. It does, though, indicate that, the Federal Reserve is acknowledging there's a lack of continued progress on inflation. Obviously, we're not hearing a Powell here in the statement that's close to actually reducing rates anytime soon. So we're not seeing that. We can look at this statement that we've got here from the FOMC. That is on screen now. This just simply is, we basically read the pieces of this here, maintaining the rate. And this right here, this is what I really want you to pay attention to. The committee will slow the pace of decline of its securities holdings to reduce the monthly redemption cap on treasuries from 60 billion to 25 billion. So again, that's more untightening than we expected. We were really looking for this to be cut in half. So we'll be going into making our bingo card here in a moment. But again, I think this is a hint that we are going to get a more dovish Powell here. So I would say this actually just flipped the balance. I went into this thinking we were going to get a 60-40 hawk dove. I actually think because of that $5 billion signal, we're probably a 60 dove and a 40 hawk. That's my opinion here. So that is a little bit of a change based on the data. Remember, when the data changes, I change my mind. All right, let's listen in here.
That last line of that first paragraph.
You know, I wonder, because the discussion among Fed officials who did speak in the week before the quiet period was more hawkish. People seemed genuinely concerned. I don't think that maybe there was disagreement with this. I just wonder how much conviction Fed Chair Powell will have in this news conference to really build on that and say just how much less conviction they have and just how much they're going to do to offset some of the lack of progress.
I think they've got to wait for more economic data. And the bottom line, John, you quoted off Jobs Day. Do we link right now to Friday's Jobs Day? I'm sorry, we do. There's no real indication here of the labor market cracking. JOLT survey today was a little weak. Bob Michael mentioned that, but I just think they have to wait. They're in massively exposed position.
Fantastic lineup going into the news conference. Bob Michael's still with us. Joining us now, pleased to say, good friend of this program, good friend of ours, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, you've had a few minutes.
Oh, hey, it's also worth noting that Jay Powell probably already has the jobs data for this Friday. So consider that. Jerome Powell probably has the jobs data. Now, quick reminder, as we're gonna set up a Fed bingo card in just a moment and keep getting reaction on this more dovish move here from the Fed. Nvidia is now up about 1%, so we're at about 3.6% down. So we're getting a little bit of a rally here. Look at that. You're seeing that dovish Fed getting priced in. Now, this is also common. You get a statement, the market goes up, and the market often falls going into Jay Powell talking because he could take it all right back. So if you're actively trading this, be very watchful of what usually happens in these trends. But this is more dovish than expected. I think Jay Powell probably already has the jobs data for this Friday, and maybe there's a reason we're getting a little bit more dovish here. Are we starting to see cracks in employment, in the employment reads? We did see, obviously, the JOLTS figure come in a bit lower than expected this morning by about 190,000 jobs, although we did get an up revision of about 70-ish K jobs in the last JOLTS report. We do have hotter ECI, hotter pay gains than expected, and hotter inflation, so we'll see how things move. But clearly the market is picking up on this slightly more dovish tilt, and so we're getting a little bit of a move upwards. I don't know how sustainable that will be, so we'll watch that. A couple things to remember for today is that after Jerome Powell speaks, we're going to do a summary video, so I just want you to be prepared. We're going to cover Jerome Powell, then we're going to do a summary video, then we're going to do a HouseHack Q&A. So a live Q&A, if you're an accredited investor, you're interested in learning about the difference between HouseHack or mini funds, all the stuff we're doing, you've got questions, we will do that live. We've been to 20 cities in the last 7 days. We're going to 2 more cities today, Long Beach and San Diego. If you want to come visit me in Long Beach or San Diego, just go to househack.com/2024 and RSVP. That's San Diego and Long Beach. That'll be later today. And then we'll have completed 22 cities in 8 days, which is pretty remarkable for a roadshow. Let's listen in to get some more commentary here. And then, of course, we are going to make Fed bingo, and we will be ready in about 24 minutes.
Responsive to higher interest rate for longer. It really isn't. So if they acknowledge the softer economy, they end up having to then discuss, at least internally, whether 2% is the right inflation target. And a phrase that John did not read out in the statement is they are strongly committed to returning inflation to its 2% target.
Give me a chance, Mohammed. I was just itching to get to you, to get your reaction. Bob Michael with us as well. You're going to run with that phrase.
I think Al-Erin just threw you under the bus.
I think he did.
I think he did. You failed, John.
Can we get Mohammed back up? I was going to turn to Bob Michael and get his thoughts.
What's great about this is you at least read the statement.
Hold on a second. But that was in it before.
What a waste of time those people are. Let's try over here.
Probably until December.
All right, so Steve Leisman, let me just get any further thoughts that you might have, having a little more time to read the statement and pull your thoughts together.
Well, I mean, I have a hard time seeing this as stagflation or in any way, shape, or form. Stagflation is high unemployment. It's high inflation. It's no growth. We are so far from any one of those three. Not that it couldn't happen, but stagflation assumes something is sort of broken in the price mechanism in the economy. And what would be broken there would be that if you do have weaker growth, prices would not adjust downward. We don't know if that's the case. I just think we're a very long way from stagflation. As for the Fed, I would say this. This statement reads to me like a plane that's circling. They're waiting for time. They've acknowledged there are a little bit of turbulence in the air there. They perhaps see some fog on the runway. So they're not quite ready to land yet, but I do think they want to land this plane. I think they're still on course to try and land the plane, Tyler. It's just that this is a holding pattern, this statement here, before the data either breaks towards weaker growth and lower prices, and or you get a move higher in inflation, which would engender a different kind of response from the Federal Reserve.
Engender, yeah, that's an interesting word. Okay, so let's go ahead and get going with our Fed bingo here, okay? So Fed bingo. What I'd like you to do, if you're watching, start shouting out some ideas for what we think we're going to get for Fed bingo, what we should have on the bingo card. Jay Powell will be live in 21 minutes, and then again, after Jay Powell's live, after our summary, then we'll go ahead and do the HouseHack Q&A for accredited investors. Or if you're just curious what the heck is going on, or you're a non-accredited investor who invested previously, otherwise you're welcome to hang out. Okay, so the first thing we're going to do on Fed bingo is we're going to, switch to the bingo board. There we go. I made a bingo board. You know, I should probably get like a template bingo board rather than making my own. But anyway, we'll start with this, okay? Jay Powell on time. And then, of course, let's give us another easy freebie here, okay? How about this one? Nick T next to New York Times Blondie. Okay? So we got that one. Those should be should be an easy row so far. Okay? Now we're gonna go with believe at peak. All right. Obviously open if necessary. Open if necessary. Okay, that's understandable. Then I think we're gonna get something like Jay Powell, and when it comes to rate cuts, the goal is to start cutting this year, right? Goal to start cutting this year. Though he'll dodge how much. We won't go with how much. So then we'll go with let's see what a purple tie. Okay, all right. I'm okay with that. You know, seeming apolitical. That's a good one. I like that purple tie. I don't think we'll say anything about. I mean, yeah. Okay, maybe let's go with politics won't affect us, right? Or something about being independent, neutral. Uses an iPad. Ooh, that's risky. He didn't like that. He tried the laptop once. He tried the iPad. He boomeranged away from that. X months is not a trend. Oh, that's a good one. Okay, all right. I like that one. Let's put that over here. X months does not make a trend. That's a good one. Then we've got geopolitical, let's see, flask under the table. I went to high school with the Blondie. She was valedictorian. Dang, Scott. That's crazy. That's really cool insight. Mentions meet Kevin. Oh, yeah, we got to write that one down. Let's see. Fed buying assets. Shut the effing door. Enters from right side or left. You know, always enters from the right side. Obviously, something like data dependent. I think that would be very. That's just an easy one. So we'll throw this over here in the corner. What about? Is he going to mention the word stagflation? That's a good idea. What about the word recession? It's an idea there. So we'll go stagflation or describes stagflation. Yeah, something else we would want to look for is some kind of hint about what potentially happens with the jobs market, right? So weakening in jobs would lead us to cut sooner. That I think is a pretty good line right there. Softening, 1 minute late, election, data dependent. Some of these are funny. Brings up real estate. Or geopolitics. Yeah. Let's do that. Let's go with geopolitical risk, oil, instability, right? Those are sort of roughly one and the same over here. Middle East, that would all be in here, sort of Mideast. There we go. Let's see here. Can you repeat? Ooh, asks to repeat the question. That's a good one. Ask to repeat all or part of the question. It's usually part. So ask to repeat part of a question. Ooh, I like that one. That's a juicy one. Okay. That's not my job. Ooh, maybe. It's possible. Wage price spiral. Ooh, seeing him say spiral. That's a risky one. Okay. Economy remains strong. I mean, he's going to read the statement, so we don't want to give us too easy of one. Because some of these things we know are in the statement already, so we're not going to get that. Something about why, they're going to get questions about why they went for 35 versus 30. Why 35? So I'm going to say asked why 35 bill versus 30 bill. And then, some form of obviously dovish response to that. I do think that right now we're going into this 60-40 dovish now. That's a flip from earlier because of that Treasuries runoff. So, but some form of like ending. Does he end the meeting dovish? Let's see. Ending the meeting more dovish than 60%. Let's go with that. And so then I think we're probably going to be into sort of a slow rally into the close. This morning with everybody in the course member live stream, we had like 1,100 people there, still responding to emails. So we actually haven't moved the price up yet. But anyway, that's at meetkevin.com. We came up with a strategy of if this, then this. And we exported that and sort of gave everybody a picture of that. But we worked that together. But yeah, I think ending a little dovish here is potential. Buckle up. No, I don't think he's going to say that. Immigration, yeah, that's a good idea. Some form of split in wages, right? Or split in jobs market, like immigration and lower skilled doing well, but white collar less well, right? Something like that. Okay, so something like that. Now it's a little more complicated, but incorporates a few things there. Changing the target, right? Maybe something like maintain. We'll put that over here. Maintain 2% target. Obviously, I think an easy one is the balance is more the risks are more balanced. But maybe over here we should put something like possible we won't cut this year at all. That's a risk factor. And then maybe we do something like this. If I had to rewrite the SCP today, because they're not doing a summary of economic projections, right? My rate forecast would be higher. Something like that. I think that's a reasonable question that could come up. Banking stress. Yeah, I'm going to go with banking sound and resilient. Though, keep in mind, by them trying to stabilize the treasuries market with less of this runoff, they're basically hinting that maybe the market isn't as stable as they actually think, right? So stay tuned for that. Again, for those of you just now joining, J-Pow comes out in 14 minutes. We'll be covering that. After J-Pow, we'll be going into a summary on J-Pow, and then we're going to go into a HouseHack Q&A. So if you're interested as an accredited investor, the deadline to sign the subscription agreement is today. If you don't have your letter yet from attorney, CPA, Invest Ready, that's okay. You'll have a little bit of time afterwards to get your letter, to fund, whatever. We don't want people to be stressed out today. It is J-Pow Day, but it does let you sign that subscription agreement to make sure you're on time with that deadline. And you can do that at househack.com/2024. Okay, so artificial intelligence. Ooh, that's interesting. Buy Bitcoin and gold, domestic manufacturing, geopolitical concerns. Something about GDP would actually be very interesting. So this, like parts. So I'll say maybe a split on GDP. Some parts like exports, inventories weak, but GDP overall strong. That's some kind of commentary on this. How about the lagged effect of real estate? So we touched on this at the beginning of the video. So we should go in here and maybe do lag effect of real estate rent between market and what is observed in the owner's equivalent rent, right? And let's see here, something about maybe inflation expectations being stable. Inflation expectations stable. Well anchored. That's the word to use. That's a good one. Good choice. And laughs at a question. Okay. All right. I'll write that one down. Laughs at a question. All right. And then bank charge-offs, needs to see more data. We put in here the potential for higher rates by the end of the year, possible no cuts at the end of the year. Asked to repeat a question. Did we put in anything about X month doesn't make a trend? We should put in have not gained more confidence. Have not gained more confidence yet. Oh, you know, another thing we should do is we should put in here the second half should have lower inflation, right? So I'm gonna double these up. I'm gonna just in this right corner over here, second half of year should have lower inflation. All right, so cheating a little bit, I feel like, on that one, but you know what? I think that one's fair. We might end up getting both of those anyway. So there's our Fed bingo card. Feel free to screenshot that if you want to play along on your phone or whatever you're doing. So we are now looking at markets reacting. You've got NVIDIA sitting about 4.37 to the downside. Really gave up some of that rally there. Looks like it's moving between our VWAP and our 200-day moving average, really where it's getting sandwiched. Something to remember, too, I'm not sure a lot of people are aware of this. A lot of folks were asking me, they're like, Kevin, where are you doing the market open live streams? Now, it's all on this Meet Kevin live channel. So make sure to subscribe to this. This is the Meet Kevin Market Live channel on YouTube. I often also dual stream it over on Twitter and X. Obviously, right now I'm also streaming it on the HouseHack channel because we're going to be doing the HouseHack Q&A after JPOW. But yeah, the Meet Kevin Market Live channel. That's where you're going to be able to get some of these morning market open live streams every day at 5:25 when the market is open. I conduct those. So yeah, and my goal always is to just give you as balanced information as possible. Let's listen to this person. He looks angry.
0.4 was too strong. I understand that. But what was the consensus call? 2.5%. We got 1.6. I'm a numbers guy. That's slowing. And if we look at the GDP price index, it was...
Oh, relax, dude. The GDP price came in a little warm, but relax about that 1.6. Inventory drawdowns and exports, that is not a sign of the U.S. consumer. And the consumer is still doing very well. How much longer? Well, that's a big question.
The labor markets don't think it is. But I will go with the numbers. I don't like changing midstream. So it could be a consensus call that stagflation's a low probability, but it's a significantly higher probability than it was a month ago and much more significantly higher than it was a year ago. And once again, the guidance from the Fed has been very wrong. People want to blame the markets. You could say dot plots. You can point to anything you want. But even the Fed chief Powell has had a lean towards move. They still have a lean. The question isn't whether they're going to ease. It's that they're going to ease. Well, what if inflation goes to 4.5%? So I'm a hard numbers guy, and the numbers do not back up most of the conversations I hear.
Well, he will certainly be asked, won't he, in a few minutes' time, in about 8.5 minutes' time, he will certainly be asked whether there is a possibility that inflation resurges and he has to raise.
Yeah, you know, that's not my base case. And to be frank, my base case isn't necessarily stagflation. But I think that if you have a runway long enough right now to consider all the moving parts, I cannot dismiss how debt is a growth killer. And it's not only domestic, it's global. And it's only going to get worse. Even the IMF's numbers have some global growth kicking up a little bit potentially in the next 12 months. But if you look at their longer-term prognosis, Debt is going to dwarf growth, and it's going to be like an anvil on top of the shoulders of growth.
Well, I worry, too, about the volume of debt that we've added to the economy, and now at higher interest rates, how much more we're having to pay to surface that debt. Let me come back, though, to the stagflation.
Look, he's not wrong. I mean, some of the numbers absolutely have been coming in hot. You know, I'm not here to say he's wrong. I think the GDP Q1 numbers, there's some problems with that. You have to think when companies aren't building up more inventory, it's because they think either demand is coming down or supply chains are looser. And the fact is, supply chains are a lot looser. That had a big weight on Q1 GDP. But price pressures, yes, problem. Big problem. First 3 months, problem. ECI, problem. The next ECI will be a problem for the next quarter because you got stupid states like California. Sorry, I know I live in California, so I'm allowed to say it. And I also ran for governor in California, so, you know, I feel like I'm allowed to complain because I actually tried to change it. Not that other people didn't try, I'm just saying, like, I'm allowed to complain. So, the problem is, you know, you've got California that's probably going to be adding 2 plus, 0.2 plus to our ECI solely because they're paying fast food workers with basically no skills $20 an hour at a minimum wage. Food prices like shot up. Chipotle, McDonald's, a lot of them are going bankrupt. The franchises, they can't pay these fees. So of course, that then is going to lead prices to go up for people who are in construction, people who are working for $25 an hour as a journeyman or whatever, electrician. Like, you're just going to push up the whole chain, which is fine. I'm all for people making more money, but let's be clear, that is also something that will contribute to an inflationary problem.
Neither the Fed nor the Fed futures market have been particularly good about predicting what's going to happen. The Fed was talking about transient inflation for a long time before they took the word transient out of the conversation. Now the Fed basically is saying, well, we're going to be ready to cut rates but now, maybe not so soon, not so fast. The market, similarly, last fall, thought there would be a lot more rate cuts coming this year than the market says today. So who's the good predictor here of either what the Fed is going to do, what inflation is going to do, what the economy is going to do?
Oh, heads up. The odds of an interest rate cut by the end of the year are now down to 1.18. 1.18. And I should be clear that 1.18 represents the number of cuts we think we're going to get. So let's write this down. So pre-J. Powell speech, we're just looking at negative 1.18 cuts this year. So 1.18 cuts. And then the bond market's sitting at about 4.63.
Still have a
on the 10.
When you're still tinkering with rates, how can the market actually rise to the occasion and accurately price risk? In my opinion, 4 weeks ago, you did not see an ease in today's Fed meeting. That's what the Fed contract is good for. And anybody who thinks that looking today is going to give you an accurate picture of July, Sep, Nova Ds, and Fed fund futures, I think they're misguided. It really is for the next meeting.
He makes this very clear. He's made the same argument like 20,000 times. But basically, his belief is that the market is really bad at predicting how many cuts we're going to get. And the only thing the market is good at is telling you is, are we going to get a rate cut in the next meeting or not? So basically, his opinion is it's binary. Do we get a rate cut in the next meeting, yes or no? Other than that, the market is not good at predicting rates. And he might be right about that. I don't know. He might be right about that. So we'll see. Take a look at this. This is the NASDAQ right here. You've got a little bit of a move up, sitting at about 25 basis points down. We started about half down. Then we got that more than expected loosening, which is dovish. I want to be clear. I'm going into this now. I'm flipped. I'm going into this 60% dovish versus 40% hawkish or bearish. Reason being that accelerated, reduction in tightening to 25 bill versus 30 bill that we were expecting. So $5 billion there. I think that was a signal that we're going to get a little bit of a dovish Fed here. So we'll see. But as you can see, the market is clearly trying to get enthusiastic here. The Qs might actually go positive. So you are getting a more dovish Fed. I want to be clear about that. Could be good for TMF, could be good for the Qs, could be good for risk assets. You can see some of that pain is going away. on NVIDIA. Now, some of that has already reversed on BTC. Some of the excitement ran up to about 58.1 there. Back to our line. Bounced off the line, 57.5. And back up. Jay Powell will be out in about 3 minutes. We'll be doing the Jay Powell Q&A. We'll be covering that. Once again, if you're just now joining, we will cover Jay Powell live. Then we'll do his Q&A segment. Then we'll do a summary of everything that's going on. Then we will do the HouseHack Q&A. If you've got questions for HouseHack, email ir@househack.com. Questions on the courses on building growth. We got so many emails last night. Send an email to staff@meetkevin.com. We're about to change the price on it. Haven't done it yet, but there were some people asking for BNPL or pay in for PayPal. And so we've enabled that on the website. So if you needed to use that or wanted to use that, you could. Okay, so Supermicro Computer is 13% to the downside. Was down a lot more. I mean, we saw this down about 17% earlier. And, seeing a little bit of enthusiasm coming back. Starbucks, CVS down over 17% apiece here. Starbucks, keep in mind, they just got reamed on their China bet. They made a big bet in China, and you've got an egotistical CEO that's going in there going, we're a premium coffee brand. This is some of the research we were doing this morning on the course member live stream. But the CEO is basically going, hey, man, we're premium. We're not going to fight these low-cost coffee sellers in China. We have a brand. We've been doing this for 25 years. And the other Chinese coffee company is like, whatever, bro, I guess people will come to us and not you. And that's basically what's happening. So you got an ego problem there at Starbucks, which is big. They're going to have to shift that if they really want to see some enthusiasm again. You got Tesla moving back up to about that 183 line, so some enthusiasm coming back there on Tesla today. Enphase kind of getting stuck up 108. It's been here a lot of the day. And look at Coinbase, right back to its 213. It's funny. It's always getting back to 213. It feels like 213. Or going back to 218. My fault. It's at 213. It always seems to go between this range, 218 and 223. It's done that so frequently. So getting ready for Jay Powell here. We are just about 30-ish seconds away from Jay Powell walking out to give us the good old Jay Powell. So we'll see what we get today. Let's listen in.
A lift on the statement, of course. Fed day reactions sometimes can really be very much a Quicksilver type of thing. You don't know if the first move is the right move, but I do think that's because there was an absence of incremental hawkishness. Plus, you had that further decline in quantitative tightening, perhaps beyond what people were projecting.
Yeah, and of course, David, I asked him what the trigger word would be here, and he said hike. Anything having to do with hike. And so, David, you were right there.
All right, waiting for Jay Powell to come in.
It will be interesting to see, however, how the chair handles questions about whether an interest rate hike was even discussed in their meetings.
Yeah, he's gonna have to play that one very carefully.
Come on, baby.
I think he'll have to admit it's always possible to raise interest rates, but their base case is still just about the timing of rate cuts, not the option of hiking rates.
And your base case, sir, just once more for the record.
At the moment, 1 or 2 rate cuts, nothing before September, maybe nothing before December, but some cut this year.
Let's go to the chairman of the Federal Reserve, Jay.
He's on time. He's on time. He's on time. He has a laptop. Is that a laptop? Dude, is that the freaking iPad? No, what is that? It's some laptop.
Mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year.
Look at that, we nailed it.
The labor market remains relatively tight.
Nailed it.
But supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored,
He
as
finally
reflected
acknowledged
in a
it.
broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually.
Yeah, feels neutral so far.
Slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Q's just gained the lead.
We'll do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
If it stays this neutral, we'll rally into the close. This is a very neutral Powell right here.
With Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that the data will have to answer.
So as a follow-up, if inflation continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina.
Pretty good so far.
Thanks for taking our questions, Chair Powell.
There she is. Where's Nick
I
T?
wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
Tesla.
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely.
Yes.
Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. Yep. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. Yep. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Good. It's pretty neutral so far. Neutral means running into close.
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations. It could be a combination of things. But If we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Good news. Good news. Where's Nick T?
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts. And those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down
or jobs.
2%. And another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Yeah.
And could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Yep, TMF pumping. This is dovish. Dovish. This is good.
Nick Timrose of the Wall Street Journal.
He's next door.
To what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained, tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what we're tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions. And that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
There it is.
So,
it's a good question.
I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year. Very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also
so dovish
monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
That was like the most dovish thing I've heard him say so far. That's really impressive. That it's like, all right, let wage gains be hot. That's okay. Inflation can come down really fast despite that. That's really dovish.
To gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Here we go.
I'm not really thinking of it that way. What we said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity, we see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
All right. That's all expected.
Steve Leisman, CNBC. If I could follow up on that, what particular areas were sort of temporary or blips in the inflation data in the first quarter, and what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing. We have put the thing under a microscope. I will say, nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence, and that it's going to take longer to get that confidence. But confidence, I just think you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast.
Well, there it is.
I think my confidence in that is lower than it was
Second half.
because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time.
Yep.
We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So
he read our bingo card.
Is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
This is so dovish. It's checking every dovish box.
2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. We didn't get, our confidence in that didn't increase in the first quarter. And in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting and there are paths to cutting. It's really going to depend on the data. In terms of the
no hike
mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the 2 mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It actually it's the time to get back there times the times how far it is from the goal. And that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus. And so we are focusing on it. And that's how we think about that.
Claire.
Bullish.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation right now we have very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
That's great.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got more supply, but those people also come in. They work. They have jobs. They spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward. Moon.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
All right. That it?
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
Yeah, good question.
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is.
That was me.
We just don't do that. I mean, you can go back and read the transcripts for every. This is my.
Oh, he's shutting her down hard.
Fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
This is personal now. Damn. Oh. Bring out the fire hose.
Thank you, Chair
Somebody just
Powell.
got burned.
Mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Nancy. Sorry.
Hey, Chair Powell, Nancy Marshall from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason
this time
having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Somebody just bought a course with the name DJT.
Chair Powell, I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing?
He literally already did. You're wasting his time.
And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low.
Yep.
But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low.
He's totally
what will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Yep, same thing.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
That's fair.
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Nice. Reminder to follow me on Twitter. I've been sort of tweeting during this as well. X, Real Meet Kevin.
With Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so, we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to completing this process and
this stuff is really boring, mind you.
Basel III endgame in a way
it's almost over. I'll do a summary.
Also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Come on, last question, baby. Last
Thank
question.
you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
What a stupid question.
Listen to, and you all do, listen to my 18 colleagues on the FOMC. You'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
There it is. Good job. That is a dovish Jay Powell. Definitely ended that meeting more dovish. We definitely got bingo as well. We'll be going through that. We're going to do a summary right now. I'm going to do a summary of everything that Jay Powell just said. So we'll do a summary here, summary video. And then after the summary video, we are going to do a Q&A for HouseHack. So if you're interested in that, you can stick around. Obviously, I encourage you to stick around at least for the summary. And then if you're either accredited, non-accredited, whatever, we've got an accredited investor deadline today. But you can get a lot of updates on HouseHack. I'll give a presentation and answer some of the questions. I'll also be in San Diego and Long Beach later today. If you want to ask a question in person, make sure to RSVP, househack.com/2024. Big thing today is you just got to sign that subscription agreement. If you don't have that accredited investor letter yet, or you get a fund, whatever, just get that subscription agreement in. Very, very important. Okay. All right. Let's get on to the summary. Ready for that? Okay, here we go. Well, Jerome Powell just canceled stagflation, canceled the recession, and canceled really any potential of rate hikes. That was the biggest fear that we had, that after a quarter of hotter than expected inflation data, of hotter ECI data, hotter ADP payrolls numbers, we actually got Jay Powell going, nah, moon, baby. How'd he do that? How'd he do? He basically unwound some of the most hawkish expectations we could have had for the Fed. He unwound the fear that we would actually have higher rates. Instead, his paths forward are either we stay or we lower. And he gave us a few paths. He actually gave us paths. He said there are three paths. More persistent inflation, hold off on rate cuts. Greater confidence in inflation, cut. Unexpected weakening in the labor market, cut. But what about these wage gains? I mean, wage gains, that could set off a wage price spiral, right? I mean, if we have wage gains that all of a sudden are too excessive, well, we're going to be back in a wage price spiral, right? That would be bad. Jerome Powell's take, we're not worried about it. We want people to make more money. In fact, last year, we saw wage gains that were elevated and inflation collapsed. And we expect the same thing will happen this year. Wow. This is way more dovish than expected. Now, the first sign that we were going to get a dovish Jerome Powell today was that we were expecting to go from $60 billion of Treasury runoffs down to 30. Instead, we got it go all the way down to 25. That extra $5 billion was your heads up from Jay Powell that this was going to be a dovish meeting. At the beginning of the meeting, I said, okay, I'm now flipping 60 dovish, 40% hawkish solely because of that flip. And then throughout the meeting, we got more and more dovishness. In fact, he even addressed our inflation expectations concern. Quite frankly, Jay Powell, if you're not a course member yet, we'll extend the coupon for another few hours for you. We got McKay and email. We'll let you come in because clearly you're reading off our bingo card, okay? You did a great job. You addressed basically everything we've been bitching about on the channel. It was really impressive. I mean, quite frankly, there was a point, it was almost as if he was reading our bingo card. He addressed both of the second half of inflation should be lower on our bingo card, and in the same box, we're talking about the lag effect of real estate coming eventually and explaining why there's this lag and split effect in real estate. He almost read it off verbatim. So thank you, Jay Powell, for being a supporter and a subscriber. We love you. Okay, but let's, in seriousness, Jay Powell addressed three really important things. Number one, inflation expectations. He finally addressed, look, inflation expectations moved up at the beginning of the year. The 5-year break-even level moved up from January all the way through about last week. We went straight up on inflation expectations. And what did we end up getting? We got Jerome Powell saying, in recent data, inflation expectation data sets have come up in the short term, but the long term remains well anchored. So he washed the short term concern. Then what about the fact that GDP came in at 1.6% in Q1? Well, as we expected he would on our bingo card, in fact, we wrote that down as well. We wrote down on our bingo card that he would split out I'll show you the bingo card here, that he would split out GDP, that some parts like exports and inventories were weak, but GDP was overall strong. Almost read that off verbatim. How? Because he told us while GDP growth moderated to 1.6% in Q1, private domestic final purchases, complicated phrase there, excludes exports and inventory buildup, and that level came in at 3.1%, which to them sends a clear signal that the economy is still actually very strong. So, washed the inflation expectation concern, washed the rate hike concern, washed the wage price spiral concern, washed the stagflation GDP concern, washed, if I didn't say yet, the rate hike concern. And then, of course, we have the real estate concern, like, oh, but owner's equivalent rent is still high. Yeah, it's taking longer to come down. That makes sense. Market rents, he says, are flat. We've seen that in housing as well. Market rents are either flat to slightly down in most markets across the country. The difference is people who are already in can't really realize a lower rent until they move. When you move, you get market rent. When you stay in, you might be locked in higher until you actually move, because sometimes there's a low chance your landlord's actually going to lower the rent, right? So this entire meeting was Jerome Powell washing fears about the economy. He says, look, it's going to take longer than previously expected to lower rates, remains committed to 2%. The labor market's been softening somewhat, but nothing that's extremely concerning at this point. It feels like a normalization. In fact, when looking at surveys, so leading indicators of employment, he thinks we're back at pre-pandemic levels, not substantially weaker. He says obviously committed to the current stance, clearly, didn't want to delve into when rate cuts will begin or how many we would get. Not a surprise. But again, the washing of these bearish factors in the economy was extremely dovish. Now, some people are saying, oh, it's dovish, that maybe he realizes something's wrong, that something's coming. But quite frankly, he tried addressing that too, that he doesn't actually see large damage in the labor market right now, because if he did, we would be cutting rates right now, even in the face of inflation, around 3%. They'd be cutting to preserve the labor market. When it comes to stagflation, he says, I was around for stagflation. Stagflation then was 10% unemployment, slow growth, high single-digit inflation. And he says, I just don't see where that is coming from today. He says, I don't see the stag or the flation. Now, I was tweeting during this as well and updating ehack.com, so you could always follow me at RealMeatKevin or check out the ehack.com page. Remember, today is the expiration for investing in HouseHack, so if you're an accredited investor and you'd want to sign your subscription agreement, just make sure you do that today. We can get your accredited investor letter after. You can wire your funds in after. Please don't ACH. Make sure you wire. And read the information over at HouseHack.com. That'll serve as a prospectus, right? And a solicitation. So let's keep going. We've got market implied interest rate cuts right now. Let's understand some of the movement in what we're getting in the market. We started this meeting with 1.18% expectation. 1.18 rate cuts expected for the year. We ended with 1.3738 rate cuts expected for the year. So we actually increased the level of rate cuts we expect for this year. We saw gold move up about 1.28%. We saw oil drop 3%. We saw 10-year treasury yields drop 6.2 basis points. And we saw all indices, the Russell, the Nas, the S&P, and the Dow, all up 1 to 2% after this meeting, when beforehand a lot of them were down as much as 0.5%, like the NASDAQ. So this was clearly a very optimistic meeting. Now, going through our bingo card just to make sure we've got all of our bases covered here. This was our bingo card. We got bingo across the board. We got the purple tie, maintain the 2% target, weakening in jobs could lead to a sooner cut, have not gained greater confidence yet, and he did address that at least longer-term inflation expectations are well anchored. He got very angry about somebody implying that politics won't affect us. In fact, I tweeted 911, I'd like to report a murder for how aggressively he responded. He says we still have a goal of cutting rates. He didn't say that he still has a goal of cutting rates this year. That is something that he said previously, so we did not get that. We got the split in immigration, jobs data. We got a split on GDP. Jay Powell was on time. We did end the meeting more dovish than where we started. We didn't get too much detail on why they went for that extra $5 billion, so we didn't get that. Didn't get a repeat of question. We did get a Nick T sitting next to the New York Times Blondie. Somebody in the chat's like, she's a valedictorian. I went to high school with her. I'm like, dang. But anyway, stagflation, and then he ended up, I wrote, stagflation or describe stagflation. Literally did. The lagged effect of real estate or the second half of the year should be lower inflation. We got all that, got data dependent, and basically we believe we're at peak. And he didn't say specifically that word, but he must have made that clear 17 different times. It was very clear. He's very opposed to raising rates. He's sending an extremely clear signal here that, yes, data dependent, it's going to take more time. Optimistic that the second half of the year's inflation is going to come down lower. So what does this now put pressure on? Well, this now puts pressure on May 15th. Now, what is May 15th? Could May 15th be an opportunity for you to get life insurance in as little as 5 minutes? Link down below, metkevin.com/life. Could it be your chance to sign up for StreamYard, which is how I multi-stream, metkevin.com/StreamYard. Check them out, both paid partners. Could it be the expiring coupon code or the deadline to invest in HouseHack? No, it's the next CPI report. See, the next CPI report just got a lot of pressure because Jerome Powell is basically like, look, the economy's fine, inflation's going to come down, things are good. Yes, it hasn't come down as fast as we'd like, but we think it's coming. He got rid of so many bearish concerns. Again, the wage price spiral, the stagflation, the real estate lag. He got rid of a lot of concerns. The hiking. These are huge removals of pain from the economy. All of that was really removed. And what he did is he put the onus on, let's just see what happens in the second half of the year and get these inflation reports. Next April inflation report is obviously May 15th. I don't actually think we have reports for that yet. We do think that wage growth could continue to push up because of things like what are happening in California, where you're raising minimum wages as aggressively, or the aggressiveness that you're seeing in wage gains from unions. But quite frankly, there was nothing extremely bearish in this. In fact, there wasn't really anything even slightly bearish. I mean, the fact that we're not going to get rate cuts in the first half of this year, that is not a surprise. It's not a surprise we're probably waiting until September to December. And the fact that we didn't get punched in the face here, we didn't get JPOW, is quite frankly neutral to, in my opinion, very dovish, which is bullish for risk assets. That's obviously, of course, why we've seen Bitcoin move up during the meeting, but I'll tell you, there's something about the lines, folks. There's something about the lines. These lines are magnetic, and so you have a lot of speculation on that dovishness going in during the meeting. Ran from about 57.5 all the way to about 59.4, but look at that drop right back down to the line. And so if you want to study those lines, make sure you're part of the Stocks and Site course. While I was live, somebody joined the course. We're going to change the pricing in a few hours. There were just too many emails. What is it? Yeah, somebody joined the course, and the name they signed up with is DJT. Like, oh man, they must be in a DJT stock. That's shout out to them, whoever they are. So there you go. That is a full summary of what's going on with JPOW. I have to say, this is probably the best version of JPOW you could get. Purple tie, on time, very straightforward, aggressively passionate about how strong the economy is. Now, could they be wrong? Yes. But the fact that we don't have to so much worry about wage gains, the fact that he unwound that, and he addressed our concern about inflation expectations, I see that as reasonable, bullish, and thank you. So shout out to JPOW. He had a very good meeting here. So good job. Now, that completes the summary. If you are now interested in HouseHack, I'm going to give you a quick overview of HouseHack. So if you want to understand what the heck it is we're doing with HouseHack, I'm going to start with an overview. Then I'm going to open this up for questions. So if you want to hear the pitch, even if you're not interested in HouseHack, if you just want to hear what's this guy up to, stick around and I'll give you an overview of what's going on over at HouseHack. So we're going to do that. And then keep in mind, we will be open for questions afterwards. So if you have any questions, you're like, hey, what about this? What about that? I don't really, you can ask anything you want. You can meet me in person in San Diego or Long Beach later today. That's an option if you'd like that. Or just ask your questions here. It doesn't matter to me. We just did 20 cities in 7 days and we're about to do 2 more cities. So I'm a little exhausted, but you know what? It's worth it because it's my dream to turn this into a multi-billion-dollar company. So we're going to go through that, and then we'll address any kind of concerns you have. So let me start with the pitch, and then after that, you can ask any kind of questions that you have. So let's start with the pitch. All right. There's HouseHack, and then there are mini funds. A lot of folks are confused about the difference between the two, and I totally understand why, because it's complicated. When we started HouseHack in the summer of 2022, we fundraised with this pitch. We're going to buy wedge deals. Trust me, bro. That was it. We had nothing. We didn't have the team we have now. We didn't have any properties. It was give me money and trust me, bro. And so what we've done since then is not only has the company doubled in value since then, but we've actually built out systems, procedures, plans. We bought roughly $50 million of real estate, and we're operating that real estate. We're stabilizing that real estate. We've got a construction team. We've got an accounting team. We've got an in-house attorney. We've got an in-house software team. I mean, we have gone from basically zero to real functioning company in less than 2 years, which is really, really phenomenal. And HouseHack is really an entity that we look at as how can we make real estate accessible to everyone, frankly, in the world? Because here's my fear. My fear is that real estate is going to become so inaccessible to folks in the long term that the wealth gap is going to widen even more. It's basically going to be impossible to buy a house for some folks. And so I have a real concern about people not being able to have reasonable access to diversifying into real estate. I think people should be able to join on the appreciation ride and not have to pay the crazy fees that exist in legacy real estate. Consider this. You want to defer taxes, go into a DST, I'll explain that later. you're going to probably pay 6% in fees just to get in. So, you're trying to defer shelter $1 million, let's say, from capital gains. You're going to pay $60,000 in fees just to get in, potentially. And then a 1% asset management fee, acquisition fees, disposition fees, waterfalls, 20 to 35% waterfalls on all your appreciation. You're going to pay these ridiculous level of fees just to get access to real estate. Pension funds, wealth advisors, CPAs, a lot of folks recommend diversifying to real estate, but the fees are so high. And so what we want to do is make it so people can get access to real estate with zero fees. So how do we do that? That's the question. The way we do that is we buy great deals. We get deals below market value that are distressed. That's where HouseHack makes its money. So if I can buy, to make math simple, if I can buy a $60 million building for $50 million because the seller's loan was coming due, like at the top of our brochure, this is a property that we bought. You could get this brochure, a copy of this over at househack.com. Printed this up. It's pretty cool. You can get that over there. We won't go through all of this. It's available there for you. Househack.com. Click the investor tab. You'll see it. We do obviously have the fundraising deadline today for accredited investors. Read about that over there. That's your solicitation. Read your PPM. But so we bought this building, and it didn't actually need a lot of work. They just needed to sell. And so we believe we got a really big discount on this. That's just an example. We've done the same thing with single families that need a lot of work. And we have the potential of purchasing a deal right now that's worth about $19 million as a fixer going into foreclosure. And they go to foreclosure on May 6th. 6 evictions, 13 vacancies, needs to be renovated, garage doors, units. It's a disaster. This is the kind of product and service that we do at HouseHack. We stabilize the real estate, we fix it up, we acquire it, we negotiate it, we scale the teams that can basically do the actual work, and we do all the accounting, the audit. We do all of that to get these properties from basically a crappy situation into a really good situation. Now that's not unusual. A lot of people do that. In fact, let's say you bought a place for $8 million that was worth 10. Great. You made $2 million. Congratulations. How do you get that $2 million out to do it again? Think about that for a moment. If you got a really good $8 million deal that was worth 10, determined by an independent board or an underwriter or an appraiser, right? How do you get the $2 million out? Well, you could sell it, but then you have to pay escrow fees, real estate agent commissions. You can't sell a single family house occupied with a tenant. You're going to get ripped off on the pricing, so that's not going to work. It'll take forever to find buyers for multifamily, especially larger deals in this environment. So your liquidity on multifamily is going to take a long time. The due diligence into the tenants, it's all a mess. It's really hard to get your money out. Now you might say, oh, but I could refinance. No, you can't. You can't get that. Well, first of all, I don't know that you want to refinance at 7%. We're operating on a 100% cash basis. HouseHack has zero debt, and we're going to keep it that way until rates are lower. But if you refinance, you're going to leave that extra 20% in the deal at the bare minimum. That'd be your down payment, so you can't get that extra out. So what we tried coming up with, and what we believe we have now come up with, is a strategy for realizing we buy 50 of real estate, say it's a $50 million purchase, and we can roll it for 60 to mini funds, determined again by an independent, either appraisal, underwriter, or otherwise. Now, HouseHack gets $10 million. That's great. Obviously, we get the full 60 back, $10 million of profit. That's just one cycle. Obviously, that's gross profit. We have OPEX and taxes to worry about, but that's not important to touch on right now because we expect those to be a lot lower than obviously what the gross profit would be. So that's how, if our first cycle goes well, we think we'll be gross profitable, quite frankly, this year. So the goal is, how do we then do more of those cycles? If I can buy 50 of real estate and roll it for 60 instantaneously with a grant deed and an underwriter, well, I want to do those cycles as many times as possible. So my goal at HouseHack is to build not a $50 million real estate company or a $100 million real estate company or even a $200 million real estate company. It's to build a company that has its own software team. It's for property management software and an M1 finance style setup of software. I'll explain that in a moment. And create as many of these profitable cycles as we can. And we'll start on the West Coast. We'll move to the East Coast. And basically what we're doing is we take $50 million, buy $50 million of real estate, try to roll it for 60, take the $10 million in profit, gross profit, Do that over and over again. First cycle we think will take 18 months. Next cycle we think will take 12 months. Next cycle we think will take 6 months. Next cycle will take 3 months, we believe. Then we could actually run multiple cycles in parallel. So if, let's say, we do 4 cycles in California a year, we think we could do 4 cycles in Texas a year, 4 cycles in Florida a year, 4 cycles in Vegas. Each of those hopefully creating $10 million each cycle. And so that's where we think we can grow our EBIT, our earnings before interest and taxes, to tens of millions of dollars per year, hopefully hundreds of millions of dollars per year. And then IPO, hopefully, no guarantees, read the prospectus, there are risks with every investment. Hopefully IPO in somewhere between 2028 and 2030, barring being in a recession, and obviously assuming these projections work, we hope to IPO at a multiple on our EBIT. So if our EBIT is $100 million, we think we could IPO for $2 billion. If our EBIT is greater, we think we can IPO for more. And sometimes markets are crazy too. Like they could give you a way higher valuation. Look at Wingstop. They have an EBIT of just $70 million and they're selling at over 140x multiple on that for $11 billion. I'm looking at Wingstop going, well, if they can have that kind of valuation, I'm confident I could turn this into a multi-billion-dollar company. But it's not just based on that. It's based on just normal math too, like normal 20 multipliers. And also the cash flow process that we have. So now that's HouseHack, okay? That's venture capital, 2028, 2030 is the exit goal. Goal is how do we create massive cash flow without debt? In order to do that, we're going to build our own property management software, and you'll see why in just a moment. And we're going to build what we call sort of an M1 Finance style version of investing in real estate. So picture this for a moment. I'll pull up an M1 Finance chart. Imagine you could invest in an M1 Finance pie that let you allocate $500 a month, let's say, to the exact custom pie you wanted of real estate. So we go to their website, you have a pie, and each of these slices, let's say it's real estate in California, real estate in Texas, Florida, and let's say all of those are single families, multifamilies, and then over here you have the short-term rental fund or the warehouse fund. Basically, you could take $500 and allocate whatever percentage you want to each of those. The goal is that non-accredited investors can invest in those little pies, those slices, and they can do that with no fees. That's the goal. No asset management, acquisition, disposition, waterfall. The people who invest in those pies get 100% of the appreciation, no fees, and the rental income distributed to them quarterly. So it's a dividend, right? You get a dividend. This is what we want to create. We have a software team that is going to make this. Now, there are a lot of complexities around this. I am making a broker-dealer. That's why I got all of my licenses at the end of the last year, to help make this happen, to facilitate this happening. Sometimes people look at me, they're like, Kevin, how are you doing YouTube and HouseHack and you got all these FINRA licenses? I joke that like, somebody's like, oh, you get the Series 7 license. It's like a series of 7 licenses. It's because I've got the 7, the 14, the 24, the 27, 63, 65, SIE. It's a lot. But we're doing that because in order to make our app, we need to associate with a broker-dealer. And then we can, to non-accredited investors, advertise these pies. And it's not just the public, but we want our tenants to invest as well. So now tenants can actually own a slice of their own real estate for no fee. Now that's pretty cool, because if you can own a slice of the house that you're renting for no fee, you might take care of the property better, you might be happy that you're diversifying into real estate, and you might want to keep renting from HouseHack properties. If somebody moves from California to Texas because they're sick of Gavin Newsom, we want them to say, hey, got any HouseHack homes over in Texas? We want to rent from you because you're a great landlord. We love the quality of renovations that y'all do, and we want to invest in the property that we're renting for no fee and get dividends in doing so. That's what we're trying to create. So HouseHack is the creator of the property management software, that M1 Finance style pie software, the buying the distressed assets, the stabilizing of the assets. That is the multi-billion-dollar vision that we're creating at HouseHack. Obviously, there's risk to everything. One of the risks is the demand that we might get for mini funds. We believe there is a lot of demand for mini funds, but we could be wrong. One of the most popular types of mini funds, which is basically one of those slices of pie, which would be a self-contained entity. Mind you, each of these mini funds, they should be self-contained. They pay for their own property taxes, insurance, maintenance, management, utilities, reserves. They're their own operating entities that can grow up and have their own valuation, so they could IPO as their own little babies in the future with the real estate that they have. We benefit at HouseHack by rolling real estate that's stabilized over to them and collecting that cash, that difference in value. And the mini funds collect the cash flow and the appreciation, all with no fees. So the demand that we're seeing, where there's a lot of demand for mini funds right now, is in something known as a Delaware statutory trust. Now, I know some people hear Delaware and they're like, bro, do it in Texas. Elon told us Delaware sucked. DSTs, as far as I'm aware, only exist in Delaware right now. We just listen to outside counsel. Real estate investment trusts get incorporated in Wyoming. Delaware statutory trusts in Delaware. So, yeah, I know that comes up, but we just listen to outside counsel on that for now, and I'm not opposed to using other states if those options exist. But what I want you to think of right now is, let's say you have $10 million after you've sold your real estate. You've got $10 million of equity that you had in real estate. You sold that real estate because you're sick of tenants and toilets, right? So let's say you got $10 million of equity here, tenants and toilets. So we're going to put that over here. So you got the headache, you got the pain in the ass. All right. How do you go from this to not paying taxes, still having real estate exposure, and not dealing with tenants and toilets? Watch this. If I can create and list a public REIT, like one of these mini funds, if I could take one of the mini funds and list them on the New York Stock Exchange, shout out to the NYSE, love the team over there, shout out also to the NASDAQ, could be NASDAQ as well. If I could list over there, then I can have a public mini fund that is a REIT over here, and that's going to pay quarterly distributions, so we'll just call it dividends. You'd get a 1099 dividend over here, and then you'd have liquidity, right? You'd be able to swipe up and just sell your share of that real estate. So this over here is no, we'll just say tenants and toilets. There we go, no TNT, right? If you just sell your real estate and buy a REIT, you're only going to be able to put over here, maybe $7 million, because you're going to lose $3 million to the tax man, and that kind of sucks. You don't want to pay $3 million in taxes. That might be $2 million, that could be up to $4 million, just depends on your tax situation, obviously, right? That is a crappy situation. Now you have less money in that REIT, so people stick with tenants and toilets. Well, guess what we found out how to do? We found out that we can actually, you can sell your real estate with capital gains in it. You can move that into a Delaware statutory trust, and that is done through a 1031 exchange. So you own a slice of real estate that me, Kevin, bought and stabilized with the team that we've scaled and taught how to do this. You 1031 into the DST, and ready for this? Then you, after about 2 years, 721 into the REIT, and you've literally now gone from $10 million at tenants and toilets to $10 million, no tenants and toilets, and no fees on a slice of real estate. That's just one example of how we can actually get people out of having to deal with tenants and toilets, but getting maximum tax efficiency and a yield. I mean, consider this. If you got a 5% yield on money markets, you're like, I'm going to sell my real estate and move into money markets, but you're giving away 30% to the government. Well, then really what you have is not a 5% yield anymore. What you actually have is a 3.5% yield, because you just lost 1.5% to the government. So that's just one example of how we can get a demand for mini funds. And people who are interested in that are already emailing us at ir@househack.com. Soon we're going to have our prospectus ready. Within about the next few weeks, we'll have our prospectus ready for our first mini fund, and it'll be a DST. After that, we'll have our M1 Finance style Pi app for non-accredited investors. And then hopefully we also have a public version, so somebody could just swipe up on Robinhood and buy a slice of real estate. Now that real estate, we believe, will be sold or rolled, we call it, at fair market value. Yes, it is selling. But the reason I don't like using the word sell is because it implies lag and commissions and fees. But we don't have that problem. We think we can go from the real estate that we own, that's cash owned, through a simple grant deed, which is one signature with the notary, move it over into a mini fund and avoid all of the friction of selling real estate. That's why we call it roll. Yes, in practice, it is a sale. In practice, when we have gross profit at HouseHack, we are going to pay taxes on that. Obviously, we'll do whatever we can to be as tax efficient as possible over at HouseHack and the mini funds. The mini funds will do all the work for you in terms of cost segregation, accelerated depreciation, straight line depreciation, whatever. All of that cash flow goes to mini fund investors. That's for the individual properties, right? They collect their rent, pay their bills. What's left? That goes to the proportionate ownership in those mini funds. Now, myself and other execs at HouseHack will be on the boards of these companies. We'll have a majority independent board, right? That's where other outsiders are involved to help with valuation and potentially even independent underwriters. If we do non-public, so private basically, mini funds for non-accredited investors, we'll actually be required by law to have an independent investment bank with 5 years of underwriting experience put their name, their banking license on those valuations. So we're not worried about those independent valuations because we think we're getting good deals. So that's how mini funds work. Mini fund investors, again, you get the dividends, you get all the tax benefits, the depreciation, you get the, hopefully the appreciation and the growth in value of those mini funds. HouseHack simply goes from buying something at a distressed price to a higher price. That's what we capture, and we try to do that in cycles over and over and over again. Now, in the future, is there a potential that we could, license our property management software to other folks or mini funds? Absolutely. And that could be another source of revenue. Look at a company like Buildium. They had about 17,000 units under management at Buildium. They don't manage, right? They're just software. And they had nearly $1 billion valuation just for the software. And so we think we've got two huge software components to HouseHack. You've got the property management suite and the M1 finance of real estate, or the Robinhood of real estate, right? Zero fee commission. This is huge. These are game changers in finance. It's taken me 2 years to get to this point where I'm able to say I could not be more excited about this, because I think we're creating a potentially tens of billions of dollar company. Now, people look at me and they're like, but Kevin, you got YouTube and HouseHack. How do you balance that? Okay, I get it. The licenses help HouseHack, but what about YouTube and HouseHack? One of the things you have to remember is companies that do real estate funds that have massively high fees, one of the reasons they have high fees is because they have to advertise. Well, guess what we get to do for free with YouTube? Advertise. It doesn't cost HouseHack a dime for me to be talking about HouseHack at the end of a JPOW meeting to 18,300 people watching this right now. It costs us zero. YouTube is a feature. It's not a distraction or a bug. It's a feature of how we can grow HouseHack. And so are the licenses. So all of a sudden when you look, it's like, this is a laser sharp focus on the future of HouseHack, which makes sense. Because somebody's like, well, what about the plane, Kevin? Why would you, be reckless and spend $13 million on a plane? That seems risky. It's very risky. And I pay for that risk. I signed that risk. It's my debt. I pay the expenses for that plane. The 22 cities we're going to is going to cost HouseHack like $10,000 in hotels and, dinner for the guys and the team, some printing fees, $5,000 for brochures or design or whatever. Probably going to cost HouseHack 10 grand. I'm going to spend probably more than twice that on new tires, just having gotten everybody around to these 22 different cities. Let's not even talk about gas. Now, so some people look at that and go, why would you do that? Why would you buy a $13 million plane and spend $2.5 million a year operating that plane? Well, it's because I think we are building a tens of billions of dollar company. And so to me, the plane, which might cost me $20 million over a 5-year period, I think that plane is a call option on the success of HouseHack. And I've paid every single dime of that plane. So to me, when people ask, hey, what's your stake in HouseHack? How do we know you're serious? That's how. It makes zero sense to own a plane for any reason other than HouseHack. Sure, is it nice to occasionally be able to go, I'm going to go fly skiing and do a day trip and come back? Totally. But that enables me to be the CEO that can build teams, meet realtors, negotiate deals, meet sellers in person, and still be back to have time with my family and my 7 kids. That's another thing that comes up. People are like, who helps with all the kids? Right now, we have as many nannies as we have children. And we're about to outnumber children with nannies. We're about to go to 8. So let's just say we've got a lot of help. And baby Summer is home. In fact, really happy. I get to after this live stream, I'm gonna take this wristband off. This is Summer's wristband from the hospital, and I only got to hold her for about 3 or 4 minutes today because I've been live for most of the day. But and then she's been asleep during another part. But after this, I'll be really excited to feed her and hang out with her as well as all the other children. So really happy about that. Of course, she came home at kind of an inconvenient time. They were telling us that she'd come home in the middle of May, and I'm like, all right, let's do the 8-day roadshow and end it, at the end of April. Well, now, May 1st, sure enough, they call us at the beginning of the roadshow, come pick Summer up. So, I mean, that's just the way life is. But anyway, the point of this, and sort of the takeaway, the simple high-level takeaway is, HouseHack, think venture capital, think M1 finance of real estate, the Robinhood of real estate, think property management software, think building systems and teams. We go West Coast to East Coast, scale it slowly, scale it sustainably. And we try to do as much as we can in terms of working with folks to make sure we get good deals and we can stabilize those deals. Then mini funds. Mini funds, think stable real estate, fair market value real estate, that whatever that goes up in value, the investors in that get 100% of that. You get the dividends, the quarterly dividends, and all of these will be self-sustaining little entities. They'll be these little babies to where in the future, let's say we do 20 mini funds, over here on like an M1 pie, you have 20 different choices to choose from. We start with class A and B real estate, single family, multifamily, and then we go up the risk curve. As we're established in an area, we've got teams in our area, we can do short-term rental funds, warehouse funds, build-to-rent funds, development funds, whatever. We could literally have a fund for every kind of real estate that exists. As we grow those little mini funds, they can all individually IPO out of this app and basically be publicly traded. So go from private to public. That would be a big moment for each of those little pies we would expect, or each of those little funds. And we do that all with no fees, which is great. So they're self-sustaining entities. HouseHack isn't layering on fees. Obviously, they're going to have operating costs. Like I said, if you have 100 units, well, actually, I don't know if I said this yet. If you have 100 units, like let's say right here, this fund pie, let's say that represents 100 properties. Obviously, you're going to need at least one property manager. So what we do is we hire a payrolled property manager to keep that reputation up for our HouseHack properties in that individual fund. So that's a W-2 payroll expense for that mini fund, but that's okay. It's self-sustained. Any real estate you buy is going to have property taxes, insurance, maintenance, management, utilities, reserves. Duh. The difference is at the top level, so like let's say, on top of this app, so to speak, there's no 1% acquisition, disposition, asset management, 20% waterfall, 35% waterfall, DST fee of 6%. All of that BS, we set to 0. Now, why do we do that? Are we trying to burn Wall Street and burn institutional investors? No. We actually want to create white label products for them. Think about that for a moment. Let's say JP Morgan today has to charge a 1% fee to do a real estate fund because they're paying somebody else 80 bips or whatever, and they're picking that 20 basis point spread. After a couple of years, we think institutions might come to us and say, yo, Kevin, can we make a $500 million mini fund? You buy the distressed real estate. We'll pay you fair market value with $500 million for it. Can you make us a JP Morgan mini fund? And we'll put our own fees on top of it. So now what you have is JP Morgan taking our 0-fee mini fund. They could add their own fee to it. And now what? They could potentially collect 50 bips, which is a cheaper deal for their clients than the previous, 100 basis points they were paying, but they're collecting 50 as opposed to 20. So you could get a higher spread and a better product for investment banks, wealth advisors, CPAs, realtors, for basically anybody on Wall Street, pension funds, school endowments. Doesn't matter. We're creating a product that we think will become so popular in the long term that we think we're at the start of a revolution where you're going from high fee exposure, like high fee, high cost to get into real estate to commission-free trading, basically, like what the Robinhoods or the stock brokerages of today have done for real estate, or sorry, for stocks. So that's a really big deal. So that's HouseHack. That's what HouseHack is doing. those are what mini funds are. HouseHack, venture capital investment. Right now, you have to be an accredited investor. So you can invest by going to househack.com/2024. If you don't have your accredited investor letter yet from InvestReady, your CPA, your attorney, that's okay. Just sign the subscription agreement today. After you've read the PPM, I'm sure the SEC is listening. Okay, there are risks with every investment. Please read the risk factors. Ask us questions. We're going to have this open for questions right now. IR@househack.com is another option. Obviously, I'm going to answer a lot of questions right now as well. But once you decide, or if you decide I want to invest, and you're an accredited investor, if you're a new accredited investor, the minimum's $40K. If you're an existing accredited investor and you want to add a little bit, you could email us if you want to do, a little bit less, like somebody wanted to do $35K or whatever. Just sign your subscription agreement, email us, we'll take care of you. And then, of course, you want to make sure that you wire in soon. I'll give you some reasonable time to wire in. And get your letter in for either your W-2s, your tax returns, your InvestReady letter, your letter from your CPA or attorney verifying that you're accredited. Or if you're a Series 65, I think that works too. There's some licenses that work as well to verify that you're accredited. You could Google, am I an accredited investor, and figure that out. So this video, as a disclaimer, is not a solicitation. We're going to go to Q&A now. The prospectuses, that's what sells an investment. So read the private placement memorandum, also known as an offering memorandum or prospectus, whatever. Read that, househack.com/2024. Make sure you sign before the end of the day today. We can clean everything else up. That's easy. We can clean up your letter, wiring funds, we can clean all that up. But you got to get that signature in today with how many shares you want and reserve your spot. My goal is to never fundraise again for HouseHack. Now, no guarantees, but my goal is to never fundraise again for HouseHack. Because if our mini fund liquidity works the way we expect it will, with the DSTs and the mini funds or whatever, we don't think there'll ever be a need to raise money again for HouseHack because we operate on a cash basis and we think the cash flow is going to be really, really good because we found a way to take wedge deals and turn them into cash at no cost. I mean, obviously there are operating expenses and stuff, but on a gross profit basis. So that's really exciting to us. And of course, there'll be like valuation expenses and stuff, but that's not a big deal. So that's the difference. HouseHack again. Big bottom line. HouseHack, venture capital. Goal is IPO 2028 to 2030. We want to get $2 a share to be worth $20, $40, $60, $80, $100 a share, whatever we can get to. Duh. That's my goal. My reputation is on the line for that. I put everything on HouseHack. So that's the goal. Venture capital. IPO 2028, 2030. Goals. Obviously there is. Mini funds. In the future, you'll be able to invest in those. Not right now. But in the future, you'll be able to 1031 exchange into them like a DST. You'll be able to buy a slice of a mini fund. And you'll get an offering at that time. That offering will be very simple. It'll kind of be like, hey, do you want a 5% yield or a 4% yield? All the appreciation, no fees, and this is the type of real estate you get. If you look at it and you're like, I don't like that type of real estate, don't buy it. You look at it and go, I think the real estate market's going to crash. Don't buy it. You think real estate market's going to go up. Maybe buy it, right? So that decision will be able to be made when we have the various different mini fund offerings. And again, we expect to have our first mini fund offering, the Delaware Statutory Trust, open for investors within the next 30 days. You can actually already identify, if you wanted to identify a 1031, just email us at ir@househack.com to verify that, what the name is, but I believe it's HouseHack Homes DST1, the number 1. Verify that with us in an email before you actually identify, but that is coming. So sort of testing the waters with that and wait for the memorandum before you actually complete any kind of investment, because obviously we can't complete an investment in mini funds until they are ready to accept capital, which they're not yet. So that's the progress. That is HouseHack, mini funds in a nutshell. And I understand it's a complicated nutshell. There's a lot that I just talked about. I cannot wait I cannot wait to not pitch all of that for HouseHack again and only pitch mini funds. And that's why we're ending the fundraise today. Because this is complicated. This was a lot of information that I just gave on what we're doing. Some people say, Kevin, you're so transparent about what y'all are doing, and it's subject to audit and all these independent valuations and FINRA and the SEC. Like, can't somebody just copy you? Sure. Good luck. real estate is hard, and you need to know a lot about real estate. And so I think our moat is in the software we're building, the way we're building it, the quality of renovation work we do, the way we can scale real estate, the fact that you've got a CEO who pays for his own plane that can get around and actually scale this business, and this hasn't been done before. I don't think Wall Street is really interested in shooting themselves in the foot and killing high fees right now or anytime soon. So it'll take some time. Obviously, there's risk, but we think what we're doing is very moated because real estate is hard. It's a pain in the ass. Let's just be frank. I love it. So there we go. Thank you so much for listening to this pitch. What we're going to do now is we're going to open this up to Q&A. So whatever Q&A that you have, feel free to ask away. Thank you, King AC. That's nice of you to say. Let's keep this to HouseHack questions. Let's go ahead and get into it. Let's see. Okay, so somebody says, on my share cert, it says shares are worth 0.001. No, that's not how share certs work. When a company is first created, what you do is you create, you authorize that's called par value. You authorize like 1 million shares at $100 or something like that, right? That's not the value of the shares. That's the par value, the initial, you formed the document. The value of the shares is $2 per share. So that's a par value question that you have. What I encourage you to do is chat GPT the difference between par value and share value. Also understand that you can, you can Google this. You could also look up the par value for other companies and you'll see the same thing. So that's very different. If 1031 into a mini fund, wouldn't I still be taxed as soon as I sell? Yes. If you sell out of the mini fund, you'd get a tax. So let's look at that again. Let me explain that. So I'll show you exactly where the tax would be. Oopsies. Sorry. That's an earnings call I was going through. How did I just pull that off? There we go. Sorry about that. Okay. So to answer your question, where do you get taxed? Do you get taxed when you sell your real estate? No. If you 1031, this is called a 1031 tax deferred exchange. No tax here. Do you get taxed when you move into the DST? No. Do you get taxed when you 721 into the REIT? No. Do you get taxed on your dividend distributions? Yes. Qualified, non-qualified, and return of capital. There are 3 forms of taxation that go into a dividend for a REIT, if we use the REIT structure. Now, if you sell shares of the REIT because you're like, all right, I'm done with tenants and toilets, now I have the shares of the REITs, now I feel like selling. Will you pay tax at that point? Yes, obviously, because now you've deferred taxes until the sale. But what most people do is they keep the shares forever, and then what they do is, when unfortunately they get hit by a bus or, the Grim Reaper comes one day, what you do is you get a stepped up tax basis, obviously estate tax limits, talk to your CPA, I'm not a CPA, and those estate tax, or those capital gains could disappear through a stepped up tax basis. So let's say you had $10 million in real estate that was fully depreciated. So if you sold it, you had to pay gains on $10 million. You get hit by a bus and you're no longer with us, and then and your children basically would get a stepped up tax basis, and if they sold those shares the very next day, they would pay $0 in taxes thanks to the stepped up tax basis. Obviously laws and stuff could change, but the stepped up tax basis has existed for ever, as far as I can remember. But it's a very good question. Ahmed, email us at househack.com. What happens to HouseHack without Kevin? Great question. First of all, we got life insurance in as little as 5 minutes with HouseHack as a beneficiary. So, of course, any startup is going to have what's called key man risk at the beginning of the startup. But the good news is we operate on a cash basis, and we're actually buying real assets and building real products and real teams. So the goal is to turn HouseHack into really a company that can operate as sustainably as possible without me. Now, obviously, as we move through the frontier, that is, we open up new locations, I'm there, I'm in everything. But right now, if we open escrow on a deal that, somebody's like, look, Kevin, we underwrote it, it's a great deal, we negotiated, I go, sounds good, team's done a great job, they've been training them for over 2 years now, and we got a lot of great people, a team of 15. What you'll find is you need to be on the frontier, but not to buy it, to do the escrow, to do the acquisition, the renovation, to deal with the tenants, deal with the problems. That's all a trained system that already exists. That gets done without me. And the point of that is, as people are trained well, we can scale. I work on the fringe. I work on sort of I like to call it like holding the shield, and I'm pushing the company forward. So obviously, yes, there's risk, but the goal is that I can train people to also pick up a shield, push the company forward in the future. But yeah, absolutely true. That is a risk. Thank you for your time and commitment to HouseHack. It was great meeting you in Orlando. Thank you so much for being here. I'm between financial guide investment. They do PWN supporting. Can you explain the difference between? Explain. I'd really have to look into some of these other, potential investments or opportunities you're talking about to really compare. A comparison I like to use is look at like Fundrise. They spend like $20 to $30 million on marketing a year, and the fees that these companies have are insane. Or you look at even like, what's the other one? What's it called? It's like Aurora. There was, what's that Jeff Bezos real estate backed startup. It's called, what was it called? Oh, I don't remember what it's called. But I went through their, Arrived Homes. I went through their prospectus for the individual investments, and I'm like, holy crap. These are more fees than I've ever seen in my life. These are like money-losing companies that are blowing money on advertising. Oh, Jeff Bezos, this or that. What does Jeff Bezos know about real estate? People are like, who are you talking to for like insight into HouseHack and advice? Imagine this. Professionals in real estate investing, in building real estate funds, real estate attorneys, real estate CPAs, real estate tax attorneys. Those are the people I talk to, people with real estate experience. So good question. But yeah, you really, when you compare different options, you just have to compare the fees. That's really important. Go into the prospectus, press fee, Command F fee, and understand some of the difference there. Okay, why is this not registered with the SEC and operates under an exception? Because it's an accredited investor round. So the way an accredited investor round works is you could do a general solicitation to investors who are accredited, who can do their own due diligence. Now, we did a non-accredited round that was registered with the SEC under Regulation A in September and October of last year, which allows non-accredited investors to invest. We're not doing that kind of round right now, so we're operating under the Reg D exemption. So is there a timeline on accepting my holdings within Pulley? Pulley is our transfer agent. You get an email, accept your share certs. I don't think so. But obviously, whenever you accept your share certs, you get your copy of your share certs. What is the accredited investor equivalent in the UK? International investors might actually have an easier time doing this, because what I would just do is, if you're international and you want to invest and you think you're accredited, you've kind of Googled and you're like, that sounds about right, I should qualify for that. What I would do is I would consider signing the subscription agreement today, then call your CPA and your attorney, or do that even today. But if you're in the UK, you're not doing that today anymore. Call your CPA and your attorney and go, hey, could you do me a favor? Can I pay you to write me a letter to say that as an international investor, I would qualify under the accredited investor guidelines if I was in the United States, but I'm international. That's good enough for us. So can HouseHack roll over the ownership to mini funds with a premium or multiple to market value, since all the hard work and yeah, not a premium to market value, probably not. Because we want people to buy the mini funds and expect that they're getting something at a fair value. We're not trying to get a premium on that. We want those mini funds to build their own premium, because the better mini funds do, the better it is for HouseHack. So it's win-win. We do a good job for them, HouseHack wins, and mini fund investors win, and tenants win. We got to have a quality asset. We got to have quality products, and real estate is hard, but we could do that very well. So they could grow their own premium in the future, though. Like, let's say a mini fund raises money at $1 a share, 1-to-1 book value. The mini fund itself, if it were to IPO on the public market, it would probably, I shouldn't say probably, I should be careful with the wording. There's a chance it could go up in value to $2 a share, like an Invitation Homes or an American Homes for Rent or whatever, on its own, without any appreciation, just because they're their own operating companies. Then you add appreciation and cash flow and dividend options. So we think we're really creating an amazing product that's win-win. And done very transparently. That's the goal. Compensation for me, I'm not compensated. We don't have any stock plans at this moment. We don't have any salary. Here's the thing. for me, I don't have a salary. I don't really care about HouseHack being a $50 or $100 million company. In fact, $50 million in assets, $100 million company. Right now, growing that to 200 or 300, that doesn't excite me. What excites me is seeing this sort of like small plant blossom into a beautiful rose garden, basically. That's my dream. And so in the future, I want to do so well over time for HouseHack investors that HouseHack investors are like, please, buy yourself a new plane so you could, have a bigger peepee or whatever. That's my goal, because my reputation rides on HouseHack, and so we've got to do an amazing job. And so, trying to take a few bucks here or there, it's not for me. There's so many expenses that, sometimes we'll be at a restaurant and like, this one's on, Meet Kevin, even though we're doing HouseHack things, like whatever. Like I don't care about $100 here or salary here or whatever. We got to get to multiple billions of dollars, and we can worry about that kind of stuff later. So let's see here. HouseHack. So I'm like 10 minutes behind on questions here. HouseHack has the money and will buy distressed real estate, fix up, roll over to mini funds. But where is the mini fund getting money from? New investors. Those are different investors, right? So somebody who wants to invest, and those might be HouseHack investors too. Like a lot of folks are telling me, I want to invest in HouseHack and mini funds because they want to. What you're really doing is you've got mini fund investors who say, hey, I want a dividend. I want to own a slice of that real estate. I'm willing to pay fair market value for real estate. Cool. So really what HouseHack did is we flipped it to the mini fund. The mini fund investor gets their proportionate ownership. So let's say we have a $100 million mini fund. Somebody comes in and says, Kevin, here's $10 million on the mini fund. They own 10%. So they get 10% of all the appreciation. They get 10% of all the cash flows, 10% of the depreciation benefits via that dividend, right? So a different type of dividend. They are a 10% owner of that company. So that is a totally different investment than investing in HouseHack. So good question. All right, let's see here. Let's see, non-accredited investors, now that there is much more of a plan, what are you going to do with the money? Are you asking me what we do with the money we raise? Well, we deploy it into real estate, right? And we do the cycles. Do course members get any perks? No, the current perk is if you invest more than $100,000, you get warrants. Now, this is actually cool. So if you invest $100K, you get warrants to buy at the same prices we're raising for today, and we won't call those warrants until 2026. Now, we might not ever call the warrants, but the goal is, we called the first warrants, so we expect to call them again because, we want people to feel like they're winning by investing in Meet Kevin, right? So, in HouseHack. So, when you think about the warrants, if you invest $100K, you're able to potentially, if you want, invest again in 2026 or beyond at the same valuation as today. So it really gives you a free 18-month-ish call option, which is kind of cool. Let's see here. You can't use your warrants anymore. Unfortunately, the warrants expired. Can you pay $40K with a credit card? I don't know that we have an on-ramp for that right now, but I would recommend wiring. I think the fees on credit cards would be too high for that. They'd kill your cash back. Yes, correct, Gus. If you bought $7,500 on the first unaccredited round, you'd have 75. Yes, that is correct. You'd have 7,500 shares. You've spoken about the risk with mini funds. Would love to know more about this tonight at San Diego. What's the expected time frame to ramp the new funds? Do you see any regulatory delays? Yeah, of course. There would be any never-ending forms of delays. The expected time frame for the first DST, which would probably be an accredited round for the DST, is about 30 days out. And we hope to have our non-accredited rounds ready in the third quarter. But yes, that could get delayed. That's a very good question. What happens after you invest as a non-accredited investor? Well, in HouseHack, you hold your shares. They're non-restricted. Theoretically, you could sell them, but you have to find your own buyer for them. Yeah, but really, you hold until IPO is the thesis, but that's up to you, not personalized financial advice. For the mini funds, non-accredited investors, you get dividends, right? And then you get appreciation, the value of that mini fund growing up. Who will pay the OpEx of the mini fund properties? So I think we answered that already, but the mini funds themselves, right? The operating expenses are all built into there. They pay their own property taxes, insurance, maintenance, management, utilities, the CPA to do the audit, the other CPA to do the, whatever, right? All that is just part of a normal expense. Let's see here. Oh, okay, yeah. So low renovation. Okay, the best wedge. This is a good question. The best wedge ever is to buy a deal that needs no work, right? The best case scenario is I go buy a $60 million building for $50 million and I have to do no work to it. That is the best wedge deal that could ever exist. You want to do those all day long. Most deals are going to require work, and it just depends on the negotiation. A good question. Issuing mini funds sounds cyclical. Is cash flow lumpy? Yeah, potentially, but that's why we're operating on a cash basis, right? So yeah, I mean, we think first mini fund cycle is 18 months, end in January 2025. Next one ends in January 26. Next one ends the middle of 26. And then we get to quarterly, right? And then you can have multiple cycles going on at the same time. In fact, you could quite frankly have, in theory, a cycle closing every single day, just because you could just always be doing mini funds in perpetuity. You could have a mini fund closing every single day, theoretically. DSTs will have at least 3 a year, as an example. So there'll be a lot of cycles. HouseHack doesn't actually take much market risk if the mini fund cycle progresses like this, because we're only holding properties for 90 to 180 days. So, and the most that the real estate market ever fell was about 1.9% per month in 2009. So, call it 5.6 to whatever, or 5.7 to 6%. That's nominal compared to the discount we're trying to get anyway. What kind of yields are you expecting for mini fund investors? Good question. So, Class A, B real estate's probably 4% plus appreciation. Obviously, right now we'll compete with like money markets, but it's a diversifier, and it's Class A, B real estate and a mini fund that could A, grow in value by it being its own company, but also grow in value through appreciation. So you have to factor that in. And then obviously the tax benefits if you come in through a DST. In the long term, we think we'll get into higher cap real estate. Like, I took the guys to a 10 cap, and this 10 cap, we roll up to the 10 cap, and we rolled up with the disclosures. We're like, oh, okay, all of the $300,000 heating system, the whole thing, free of leaks is what the disclosure is. Great system, whatever. Then you've got a disclosure that's like, all the fire extinguishers, they just need a small servicing, but they're in operating condition, right? So we roll up. First thing is McKay picks up a shell casing. He's like, is this a 9 mil? So that's the start of that, going up the risk curve here on a 10 cap. We look at the HVAC system, it's leaking like a sieve. We look at the fire extinguishers, they're rotted out. If you picked them up, you'd have half a fire extinguisher in your hand. I start talking to the property manager. I'm like, hey, so what's your screening criteria out here? I mean, it's 10 cap, this is great. What's your screening like? And he looks at me like, credit. Like, do you run credit? Like, oh, okay. Yeah, we run credit. But it's only to check if the tenants are a felon. And if they're a felon, we have a second chance program and we could rent to them anyway. Down the road, in the future, maybe we'll get into the higher cap stuff. Short-term rentals could probably do a 7 cap on a mini fund. Riskier assets will have probably more price volatility, and a 10 cap could have a lot more vacancy factor that's hard to price in correctly up front, and it's a pain in the butt. It takes a lot more work. So we're going to start Class A, B real estate, move West Coast to East Coast, and then we'll get into some of the more risky products. But one could stay in one more DSTs and not convert to the REIT. Yes, that is true. But that is a Venus flytrap, my friend. See, when you go from real estate to a DST, you usually pay that 6% fee. Then you go to another DST, you pay the 6% fee again. And another DST, and you pay it again. Sure, you could 1031 back to real estate. But the whole point of going into the DST was not to be exposed to real estate. So we believe the best thing is to DST to a REIT, so you don't have to keep paying these DST fees, and you have liquidity should you want it. Keep in mind, you could also borrow against shares through a broker, through a margin loan. And not that I encourage people to use margin, but the point is, let's say you had $1 million in a REIT that you 1031'd into, and you wanted to take a margin loan against that of $100K. You could do that and not pay taxes. See what I mean? Like, these mini funds create so many delicious opportunities for investors. These mini funds, I think, are going to be such a great opportunity. Obviously, there's a lot of work between now and then, and those are separate prospectuses, but I could not be more excited about them. The big question is just how fast can we get those cycles going, right? All right, good questions. Let's see here. How will we know that JPM does not get the best properties in their mini funds versus public funds? That's such a down the road problem, right? I get what you're saying. It's like, oh, they get the better property. I'm not really worried about that. I think all of the real estate that we buy will basically be the equivalent quality product, and the disclosures will be made very clearly about where the real estate is and the class of real estate that it is. I don't foresee that being an issue. Quite frankly, I foresee too much institutional demand potentially being an issue, where it's like we have too much money. That could be a problem in the future. Again, very good problem to have. Okay. Oh yeah, somebody else is like, oh, you should do crypto real world assets. I'm like, maybe. Somebody else is like, Kevin, you need to list mini funds on the Hong Kong Stock Exchange so Chinese investors can invest or whatever. Okay, and there are endless options, right? We could list mini funds in the German stock exchange. Somebody else came to me and they're like, Kevin, you need office in Dubai. Like, okay, like we're not opposed to anything, sort of growing and getting folks on ramps into the mini funds. Awesome Jasm, I would say this is where we've had a few people reach out to us. They're like, hey, look, we're selling a certain asset or whatever. Can we sign the subscription agreement today? And then when that money comes in, can we fund it at that point? I'm not opposed to that. Just email us, what your situation is. I'm sure we can figure that out. Is the appreciation the investors receive on the real estate earmarked to the basis HouseHack buys HouseHack buys, or at the basis HouseHack rolls the mini fund? Okay. Yeah. I understand. So if we buy real estate at HouseHack for $50 million and we roll it to the mini fund at 60, the basis for the mini fund is 60. And so then the real estate would have to, if it was a double, it would have to go to $120 million worth of real estate, right? Good question. It took me a moment to read that one. When will HouseHack accept Bitcoin? I mean, yeah, in the future, I think crypto on-ramps would be cool, but not now. Let's see here. Will HouseHack allow small landlords or owners to sell their equity to HouseHack for a slice of rental income? HouseHack would manage the property. That's a partnership? No. I don't partner in real estate. Sorry. Let's see here. What's my ownership percentage? Whatever, 1 mil is divided by whatever we raise. So, but also keep in mind, I have voting control. So the shares I own are voting shares. And as an early startup, that's extremely necessary. I mean, look at, the problems that some other companies are having right now that are even more mature. But when we IPO, that ownership will go down substantially. Like the voting control will become democratized over time. Let's see here. Somebody says arrived fees are industry standard. I disagree. I think they're higher. But let's say they are industry standard. Thank you for proving the point that the fees are very high, because the industry standard is very high. Is there a fee? Yes, then it's more than HouseHack. So you admit there is a fee. How does the HouseHack ETF factor into property appreciation? Can the ETF refinance properties in the future? Okay, so the mini fund. Yes, mini funds can refinance in the future when there would be positive operating leverage. That would then create potentially more opportunity to grow the fund, buy more real estate from HouseHack, or return capital to investors. So yes, a mini fund could refinance in the future and return capital to investors. Yes. ETF is a different topic. Could we, in the future, IPO multiple mini funds and put them all into a bundled ETF? Of course, but that's down the road. All right, so, boy, I'm 17 minutes behind on questions. Sorry, folks, I'm going here. The 1031 into DST, does it automatically transfer the REIT after 2 years? Could I decide to 1031 to another DST? I haven't figured that out yet, but that'll be in the prospectus. It will probably be at the board's discretion of that DST. So if for some reason we can't complete the 721, then you would have the opportunity to 1031 out. Again, I don't know why you would want to do that, because then you're going to pay a lot of fees again, but TBD. Kevin, how will we know that you... Oh, okay, I answered that question. What's the goal to get the mini fund app out? Minimum viable product, end of the year. That's the goal. Let's see here. Okay, I got in the Reg A round. Nice. Can HouseHack roll over the... Okay, I answered that. Some of these I've already answered, so I'm going to scroll ahead. Let's see here. Kevin, no, there's no management fee. There's no performance fee. There's none of that. No. What about having a financial qualification as an international investor? That might work. Email us at ir@househack.com. Fill out the subscription agreement, and then we can see if we could use that. Thank you for the answer, Kevin. You got it. How will the shares get distributed once the mini fund IPO? Well, I mean, like if you buy in a mini fund, if let's say there are 1,000 shares of a mini fund and you buy 100 of them, you get a share cert. If it's public, it would be through your broker, like Robinhood or TD Ameritrade or whatever. If it's private, then it'd be through a transfer agent like Pulley or something. I just arrived here. U.S. economy. Let's see. Spoken about the risk of money funds. Yeah, okay, we'll talk about that. Yeah, we answered that. Fundrise secures $770 million credit facility from JPM. It's not hard to do. Congratulations, Fundrise. You are paying probably 6.25% to JP Morgan. Good job. We think we can beat Fundrise's butt very easily. That's my opinion. Let's see here. I never uploaded my JPOW vid. I was going to do that. Okay, let's see here. Yes, assets would need to be assigned to the DST. For example, if the interest is 10 to 15 mil, subtract from the 60 needed to list on the REIT. Yes. So you would take a proportional share, you would list that on the New York Stock Exchange, and for the DSTs, you take a proportional share, and then that proportional share, we would just use that cash to go buy more properties to fill up the bucket again. Appreciation that investors receive earmarked to the basis that HouseHack buys real estate. Okay, we answered that. Sorry, I gotta stop reading the duplicate questions. I'm at 1:16 for questions right now. 1 minute or 1:16 p.m. Biggest risk for HouseHack, in my opinion, is that we don't do mini funds quickly enough, or there's not enough demand for the mini funds. That would be the problem. I don't think that'll be a problem. I think that would just delay the time frame, right? If it takes us 6 more months to sell out a mini fund, for example, oh well. HouseHack will set up the mini funds and incur some costs. Yeah, exactly. Yes, HouseHack would incur some costs. Yes. But again, we think the cash flow is going to be so much higher than the OpEx. Big HouseHack fan. Only thing I'm concerned about is the consistent multifamily demand or mini fund demand at IPO. Yes, that is exactly the risk. As far as big institutional money interest, I think that comes after probably a 2-year track record. Crypto down the road. Mini funds independent for HouseHack. Exactly. Okay, you're talking to somebody else. Can I invest in HouseHack using my IRA? Yes, you actually can. You'd have to use a self-directed IRA, so you'd need to find a custodian something like directed IRA. So you could do that. And that's going to take you a few weeks to set up and get done. What I would do is probably make sure you sign your sub agreement, and then after you do that, we can sort of work through some of the details of how to make sure that it gets taken care of. But yeah, that'll take a little bit of time. But yes, you can. You're able to raise money for HouseHack and mini funds through infinitely. I don't want to raise money for HouseHack. I don't want to raise money for HouseHack at all anymore. I want to be done with this. This is a very complicated explanation, right? Think about it. How hard? My pitch was 30 freaking minutes for understanding HouseHack and mini funds. It's hard. You have to really pay attention to understand it, and even then, sometimes it's a little blurry. Mini fund pitch would be easy, because with a mini fund pitch, all you do is you say, do you want, say, a 5% yield or a 4% yield with all the appreciation? Here are the tax benefits. Here are the locations of the real estate. and you get 100% of the appreciation without fees. Do you want that, yes or no? That's a mini fund pitch. Think about how easy that is. That is such an easy pitch. Compare that to what we've had to do with HouseHack. My goodness, it's a lot harder. Now, as far as like diluting in the REITs or like mini funds, I mean, usually when a mini fund raises more capital, they're adding real estate. So sure, theoretically, is there dilution in the like if you take a $100 million company or $100 million mini fund, let's call it. You take a $100 million mini fund, you own 1% and $1 million, and then it buys $200 million more of assets. Yeah, now you own 0.5%, or it grows to $200 million, and it raised money for that extra 100 mil. Yes, now technically you own 0.5%, but you own 0.5% of $200 million, so you still own $1 million. But the fund grows, and then potentially the fund attracts a higher valuation. That little mini fund could get bought out in the future by a Blackstone or whatever at a premium, and then you would get that, proportionate slice of premium. So that's a good question, but it's all very normal in like real estate investment trusts for you to theoretically, yes, you have dilution, but again, you're growing the pie. So I think that's less of a concern there. And again, I don't want to raise money anymore for HouseHack. I want to be done. This is a long explanation. I've literally done these conversations 20 times, and I've got 2 more to go. San Diego and Long Beach. Then I'm done. Then I'm taking a break. Could you imagine that, me taking a break? Oh, man. Good Lord. Okay. I think a CPA is a financial advisor. No. CPA is a certified public accountant. A financial advisor is like someone with a Series 65 license. If I have like if you have somebody's like, if I have 10,000 shares of HouseHack now, will I still have 10,000 shares when I IPO? Yeah, I mean, unless you lose them, which I mean, they're on our cap table, so that's not really possible. You could sell them, but yeah, I mean, you hold your 10K shares, you still have your 10K shares. Who is paying out? Okay, we explained that with the mini funds. In my opinion, HouseHack is pretty simple. It's basically buying real estate the same way Kevin has taught on YouTube for the past 7 years, just at scale. And mini funds allow to basically recycle the funds. That's a pretty good example, or a pretty good explanation. That's pretty good. Give me 1 second here. I need to put this title in here. Summary. Wow. Market tanks after Jerome Powell goes dovish. Full explanation. There we go. Let's post that. There we go. Full Fed explanation. I just have to hit post on that really quick. Did it. Okay. Yeah, I forgot I had that video exported already because we did the summary video. I just forgot to upload it and actually post the darn thing. But now I did. Okay, so now we can keep going with the Q&A. See, look at that. Okay, next. I hate Zillow. It's not a surprise that their volumes are going down. I'm a tax guy working at TTD in Ventura. Previously worked at a CPA firm in real estate for many years. Wanting to know if you want an in-house CPA. We're probably going to be hiring more in October. Like we've got 2 right now in-house CPAs and 1 person who's sort of our in-house accountant but not licensed as CPA. We're totally down to grow and expand, but probably that'll be like Q4. And that's awesome, man. On Trade Desk, Ventura. We'll see you at Ventiki. Say there's a 20% real estate downturn. What does HouseHack do? Well, HouseHack expects to buy during that time. We want to keep buying good deals, right? Remember, the goal, like a 20% downturn would probably take 2 years to play out, or maybe even longer. Just sort of depends how quickly that happens. We operate on a cash basis, so we want to keep buying real estate and sort of DCA in any market, and then we roll that to the mini funds. So even in a recession, there are going to be people that are like, hey, I want to buy the dip on real estate. Cool. Mini fund is a way you could do that. Kevin, okay, I've answered that question. You've asked that question quite a lot. I'm still 17 minutes behind. When can non-accredited investors get their shares? You should have already gotten an email with your shares from Pulley. So look up PULLY in your email. If you invest in a mini fund, how do you get the gains of the property value if they're never sold? Well, we could refinance and return capital to investors, and at some point they'll be sold because they'll be fully depreciated. Let's see here. Good question. Remember, again, deadline to invest is tonight at midnight. All you have to do is go to househack.com/2024, read the PPM, sign your DocuSign. If you don't have your invest ready letter yet, if you don't have your attorney letter, CPA letter, accreditation letter, whatever, your funding, whatever, if you don't have that yet, we can fix that after the deadline. That's okay. Obviously, it'd be nice if you wired your money today and you signed your subscription agreement today and you had your accredited invest letter ready. But I realize that's not realistic for people who wanted to listen to this Q&A to get all of that done. I respect that, I understand that, and so therefore we're going to make sure you have time to get in. Ramon, yeah. So we've been out of the office for the last 7 days on the roadshow. Email us at ir@househack.com. We're going to do our best to get back to you as fast as possible. Recognize we have one more roadshow to do tonight, and we will solve helping you. But we're, if we get 1,000 emails, it is going to take a minute. So we will get back to you. If you don't hear after a couple days, just resend your email. But you should. There should be no reason you don't. Unless it's obviously honestly, we're probably going to be working through Saturday and Sunday. And I'll be in there too. I'll make sure you guys get your replies. Does HouseHack get ongoing income from mini funds? The only thing potentially that I would see now would be licensing software. Maybe in the future we could, for some funds, there could be like a share of appreciation or whatever. That's all down the road. We don't need that. Somebody here wrote, Zillow dropped 10% after hearing about HouseHack. Yes! Has nothing to do with earnings, I'm sure, but that's funny. I like that. Only complaint, you drank the punch bowl of democratizing XXX. Yeah, I know. I know it's a little corny to say, but you have to say, it is democratizing real estate. So, non-accredited are not currently able to invest in HouseHack. That is correct. It's because partnering with a broker-dealer is very complicated. It's one of the reasons I'm making a broker-dealer, to solve those complexities. Yeah, if you didn't get your email from Pulley, just email us at ir@househack.com. You're on the cap table, don't worry. So the full board is in the PPM. You could read that. Why do you risk everything when you have 7 kids and private jets to take care of? Well, because that's who I am. I want to grow just as much as I want to grow children. I want to grow businesses. I would lose my mind if all I did was, I hate to say it, but it's transparent, just hang out with kids all day long. I would go nuts. I love my children, but I cannot be with them all day long. Just like I love Lauren, but we cannot be together all day long. Although actually, we're pretty good. We've been together for what, since 2008. Maybe that's not true. We could probably be together all day long. But there's only so much you can do together all day long. Are there any foreseeable hurdles imposed by the SEC? Sure. Yeah, mini funds have to be approved if they're non-accredited by the SEC. I shouldn't say the word approved. They don't like the word approved. They have to be qualified. So that would be a Regulation A offering, of course. Absolutely, there could be regulatory delays, but we can solve that. So, Kevin, these mini funds, bundle of properties, the individual mini funds manage their own properties. Okay, I'm at 1:34, so I'm only 10 minutes behind on questions now, mostly because a lot of these are becoming similar. Directed IRA equity trust can do self-directed IRA management, can recommend the latter, as fees went up a lot over time. Yeah, there are some fees if you do it through an IRA, not our fees. It's, them doing that. HouseHack buys wedge deals and sells stabilized rental properties in mini funds. Correct. What assets are left with HouseHack? Process, systems and procedures, HouseHack. Right. Well, it's either cash or real estate or both, right? So you take 50 of real estate, cool, we got the assets, the team, the systems, and everything. If we turn that into 60 of cash, now HouseHack owns cash and no real estate for a moment. Then we go buy more real estate. Simple. Let's see. Let's see here. I don't know how to transfer out of an IRA to a different IRA. Sorry. Kevin, is there a reason why you're waiting until 2030 to take HouseHack public? Well, it's all going to come down to the mini funds. If the mini funds go really, really well and people are like, Kevin, that mini fund sounds great. The DST sounds great. I want a slice of that real estate. Fantastic. That goes really well. We could accelerate the time frame. That's why we think between 28 to 2030. But I also need time to do the cycles so we can actually prove to Wall Street what we're doing. And that takes time. We're not like a SPAC, we're like, we got to build real cash flow. I don't like money losing businesses. I like cash flow. And that's what we're creating. Do you anticipate having to transform HouseHack? Okay, let's be clear. HouseHack is a corporation. HouseHack is a Wyoming corporation. The mini funds will probably be corporations that are taxed as a REIT. So clarify that. Probably also Wyoming. But again, if Texas is better, then we'll do Texas at that time. Okay, we answered that. What is the expected investing? I mean, I don't know. I want it to be as much as possible. Like, if I could 100x the shares for HouseHack, of course I would love to do that. I can't guarantee that. If I had a crystal ball, I could tell you what the future said. But look, let's put it this way. I'm not spending $20 million on a private plane with operating expenses on the plane to not try to make this a multi-billion-dollar company. I'm not, like, I look at the plane, I'm like, all right, I need to start using this again, because, like, we got to put it to work. Like, I'm paying for an expensive tool. So sometimes, I mean, I'm going to have, like, a week off of flying, obviously, now, because we had an insane amount of flight. But, then I get the itch again. I'm like, all right, I'm paying a lot of money for this thing to sit around. I need to fly again. Get back to work. So if you were to invest in HouseHack in the first round of fundraising, what would the warrants be? Well, the warrants have expired. So we gave a lot of notice. We were really good about that. Those expired, I think, like April 8th or something. Do we expect to expand the legal team graduating next year? Yes. Yeah, totally. Like, we would love a legal, to grow the legal team. Contract reviews, tenants, whatever. There's always going to be bull crap with real estate. Duh. So, yes, absolutely. Hit us up when you're ready next year. Just hop back on to say, yeah, sorry, Farmer Rhett. Okay, I'm almost 4 minutes away from new questions. Kevin could have easily forgot about the little guy, not done a non-accredited round, but he made sure to include everybody. That is true. And it was a pain in the butt, but we did it. So we did do that. That was September, October. We did the non-accredited. It was a pain in the butt, not because of the investors. It was a pain in the butt because of having to deal with, a third-party broker-dealer. Again, that's why I want to make my own broker-dealer, so I don't have to deal with a third-party broker-dealer. No, HouseHack has no plans on reincorporating in Delaware. Let's see here. Yep, a man without meaning is a lost man. Oh, Kevin is the opposite of lost. He grinds. Oh yeah, lots of grinding. That could be misconstrued, but in a funny way. Let's see here. Yeah, sure. HouseHack could in-house all of the property management, but the problem with that is then the mini funds can't grow their own sort of business valuation because they're reliant on an outside management. I mean, they still theoretically could, but I'll leave that as an option. Right now, that's not the plan, but I'm not going to say no to it in the future. Yeah, we could. This is a good question, and it's a fair question. What happens if legislation is passed where corporations can't own single families? Fine. Then I'll just buy multifamily or warehouses or short-term rentals, whatever. There will not be a shortage of opportunities for HouseHack. I'm very confident of that. In fact, it's a lot easier to do multifamily. I mean, if I could go to Chicago and buy a $60 million building for $50 million in one swoop, well, that's a lot easier than doing 100 singles. But usually the market, transitions in time. So Q3, Q4 is usually a really good time to buy singles. Multifamily can be really any time in the year because it depends on when people's loans are coming due. Okay, we answered that. Mini funds pay a dividend, yes. So somebody's like, I want the plane. Yeah, I love the plane. Is HouseHack interested in data center? Sure. There could be a data center mini fund that we make, right? Whether you build a data center in the future, that's all down the road. At what point can small investors invest in HouseHack or mini funds? 5% chance we do another fundraise for non-accredited for HouseHack, so that's probably off the table. But mini funds, hoping for Q3. Yep, that's the goal. So if I start a business at my home condo and yeah, you could take a yeah. I mean, talk to a CPA. That's obviously an unrelated question, but yeah, talk to a CPA. You could probably do that. Design your own building. You could do that too. Absolutely. That's all down the road. We don't really want to get into construction right now in terms of like new builds, unless we're using Biden bucks. So if we had Biden bucks, then then we'll do a new dev. There are Biden bucks available to buy like offices and turn them into multifamily. Of course we could do that. Kevin's like a calmer Ben Malla. What are you trying to say? I love Ben. Are HouseHack employees unionized? No. We treat our employees really, really well. How many houses per year do you expect to be buying in a year's time? All depends on the mini funds. And it also depends on a single family versus multifamily. You know, it could be hundreds or zero. And it just depends on where the better deals are. Can you have access to mini funds in Canada? Probably. Yeah, international investors should be able to invest in mini funds. Again, those, we're talking about mini funds in this video. Disclaimer. We're talking about mini funds in this video so that people can understand investing in HouseHack. This video is neither a solicitation for HouseHack nor the mini funds. However, there is a solicitation available for HouseHack at househack.com/2024. The mini funds are only being talked about in the scope of what we're trying to build with HouseHack. We're not raising money for the mini funds at this point. When do you get your HouseHack vests? I know. I really want to find a way to scale manufacturing those HouseHack vests. If somebody has a way to scale these sort of vests and brand them, email us at ir@househack.com. That'd be cool. And then we can sort of, sell them or give them out to some larger investor or whatever. Actually, no, we're not allowed to do that. The perks have to be the same for everybody. Blue Ocean Business, what would you qualify as or consider your biggest competitor? Money market funds? I don't think anybody's doing what we're doing. Would it be equally as much work to allow non-accredited investors who have already invested in HouseHack? Yeah. Still need a broker-dealer. Massive pain in the butt. And it would cost us a lot of money. And we're not available. We can't do it right now because we don't. Just can't. At minimum, it would be 90 days before we could do that, a non-accredited round. And it's I don't know if it's worth it for HouseHack because we want to close this accredited fund. I want to be done raising money for HouseHack. I just want to be done. And the reason I want to be done is because it's complicated. Mini funds, simple, easy pitch. I could pitch a mini fund in 5 minutes. I could be on the J Powell live stream. Honestly, I don't even need 5 minutes. I need 30 seconds. I could be covering Tucker Carlson, Vladimir Putin, going, hey, by the way, do you want exposure to real estate in this city? And do you want this yield with no fees and 100% of the appreciation? Consider investing in XYZ. Read the offering memorandum over here or download the app and consider investing. That's the mini fund pitch. As you can see, the HouseHack pitch is a little more involved. Yeah, we've answered that on the mini fund management. No worries on the double question. If I had 100K shares, what would be a fair value for them? They would be worth 200,000 right now. So what do you think Kevin 3 years ago would say to sell your real estate and buy a DST REIT tax-free? Well, first of all, one of the biggest reasons I hate selling real estate is the taxes. Now, it is true. I'm not the biggest fan of selling real estate. However, I have even said, 3, 4, 7 years ago, once you're fully depreciated or you're tired of dealing with tenants and toilets, 1031 out of it. So, for a person today starting, go buy your own real estate. I'm a big fan of you owning your own real estate, or do both. Do it all. You could do HouseHack, you could mini funds, you could buy your own real estate. I will never discourage people buying and holding their own real estate. But am I going to, do I think Kevin 3 years ago would think that 1031ing out of your real estate is something you don't have to deal with, and you don't have to deal with the tenants and toilets is a bad idea? No. So, you already did it once for non-accredited. Why not use the same broker? Don't want to get into that right now, but I don't want to use the same broker. B, so that's A. B, we'd still need to be qualified by the SEC, which even if I could magically file today, would at minimum still take probably 45 days to get qualified from the SEC. Are mini funds for accredited investors only? No, mini funds would probably be for everybody. That's the goal, is that they're non-accredited for everyone, with the exception of maybe the DSTs. But the odds are if somebody's 1031ing into a DST, you're probably an accredited investor anyway. Can you 1031 into HouseHack? No. Okay, I'm now caught up with questions. So if you've got any questions, I can answer them instantaneously now, basically. Any plans to offer mini funds directly to retail, similar to fundraisers? Yes, absolutely. We want to create an app that's like M1 Finance, where we can offer the mini funds directly. Yep, and just advertise that on YouTube. Is there a conflict between you selling a course teaching people how to find wedge deals for themselves? Doesn't that technically train competition for HouseHack? Yep, that's one of the disclosures in the PPM. Am I really worried about a lack of deals, though? No. I've never found a lack of deals. Never been in that situation. Kevin, I joined 2 years ago. Yeah, if you have that problem, email us at staff@meetkevin.com. Will mini funds be available at all brokers? If we go public with a mini fund, it should be available at all brokers. Yeah, that way you could just swipe up on Robinhood, Interactive Brokers, TD Ameritrade, whatever. When we'll use cost segregation. The mini funds will cost segregate to accelerate depreciation, and so the investors in the mini funds would benefit from that accelerated depreciation. Are there? I'm not sure what you mean. Or are mini funds the product? Mini funds are the product of HouseHack. Yeah. Any concern with the demand for mini funds? Of course. Yeah, absolutely, absolutely. But the good news is we think for DSTs there's really, really high demand, but we have no idea what the demand is going to be if we take a mini fund public or we do the sort of M1 Finance style app. We think it should be really good because the fees are zero. But we have no way of knowing that right now, and yeah, we don't have the apps built yet. Those are just things that we're working on. What does failure for success look like for HouseHack in 5 years? I think failure looks like we're a $100 million company now. We just stay a $100 million company, or we grow it slowly, right? So we refinance, we buy some real estate. It goes, we turn into a $150 million company over time. Like for me, that's a failure because I want this to be a multi-billion-dollar company. That's what a failure would look like. Success would be like, holy crap, mini funds are doing so well. HouseHack is a $50 billion company, and we're going to IPO, and we're buying a Gulfstream G700 for every one of the first employees, and we're growing the company even bigger. Those are like $80 million, mind you. That's like insane success. That sounds wasteful. I'm joking about that, but that's my point. That's what like HouseHack would look like. Massive success would look like. So good question. Can you comment more about ownership? Yeah. Well, the big thing is that you have to look at HouseHack as not just a monetary investment for me with the risk that I'm taking with the plane. Remember, I have to allocate like $20 million to this plane over a 5-year time frame. That's $10 million in operating costs, $10 million just in the ownership of the plane and potential depreciation loss, the opportunity cost. So really, I look at my investment in HouseHack as like $20 million bucks. Then it's obviously the time, the effort, the stress, the building the systems, the building the IP and the know-how and the training. It's a lot. The time it takes to make even these videos, to do fundraising, the bullcrap you have to deal with attorneys or tenants or whatever. That's my investment, right? In addition to obviously the 7 figures of shares. Let's say HouseHack IPOs, would trading options be available? I mean, this is like so far down the road, but yeah, usually after 60 days, shares can apply to have options turned on, basically. What is your plan for reducing the cost of taking mini funds public? I can't make my own investment bank, so, the only thing you could really do is say, hey, we're going to bring you a lot of business. Can you reduce some of the fees? Because we got a lot of things to go public, right? That's all down the road. Journeyman electrician, in the future. I think we'll be hiring again in October. Minimum investment for this round, $40K, unless you've already invested, or close, or whatever. Just email us, ir@househack.com. Will your original platform app be free to download and use? That's the plan for the mini fund app. Yep, free to use, free to invest in. Think of it like an M1 Finance. So, good questions. Okay. On the whole, would it be better for folks owning HouseHack or the mini funds long term? I mean, I look at HouseHack as basically like a mini fund with the potential to grow, right? Because we have the real estate. And so like the worst case scenario to me is it just stays like a mini fund. The HouseHack potential side, I think there's risk, but I see it as like, you know, can we 100x it? That's the goal. That's the dream. That's the vision. Mini funds are, you own a slice of real estate, you diversify into real estate, you hope the real estate goes up in value over time. You know, does it go up 50%, 10%, whatever it is, could go down in value. But you're owning a slice of real estate. So it's a very different kind of real estate investment. There, with mini funds, you're investing in dividends, cash flow. You know, we do the cost segs for you. You've got some more liquidity probably in mini funds. HouseHack, you don't have a lot of liquidity until we go public. So they're very different. A lot of people looking at it going, I'll do both. But, you know, what a lot of people do doesn't necessarily mean that's what you should do. Remember, risk with every investment. Read the prospectus. HouseHack.com/2024. What's your favorite rental property rule to calculate ROI? It depends. You know, you can't use a single rule because every state is different. You know, if I go to Texas, I have to use a 50% expense ratio. If I'm in California, I use a 35% expense ratio. Because property taxes are so different. HouseHack makes money between the delta of the price HouseHack acquires the property for and what mini funds underwrite it at. Correct, but it's also what we acquire it for and spend renovating it or stabilizing it. But yes, in principle, what you said is exactly right. That's the delta we make money on. But then it's also creating that M1 Finance style app, that system, and creating the systems to do that over and over and over and over and over again. Shout out to M1 Finance, by the way. I really like them as a company. Obviously, they're in stocks, you know, different world. So how well does the market represent real estate appreciation? Well, I mean, you have to look at like a Simon Property Group, I think. That's a risky style investment because you're investing in, you know, high quality malls like Westfields and stuff, I think. But look at Simon Property Group. It was selling for less than book value during COVID. Duh, everything shut down. Now it's trading for 9 times book value. So I have no idea what the market's going to decide. So can Canadians invest? Yes. Can you comment on property management as the company scales? And where do you continue to find company management? Yeah, I mean, that's hiring. It's training. I like hiring people and training them. So, I mean, that's just a human capital issue and scaling. I mean, we're overstaffed with 15 people now for, you know, $100 million company. I can manage the real estate we have with way fewer people. But we're building the company out and training people so that way we're ready for a multi-billion-dollar company, right? Okay. I just had to check when my flight is. Because we're going to San Diego and Long Beach today. You can meet me in person. I'm going to ask if you've watched this video, because then I don't have to spend as much time doing the pitch. I'm exhausted. What would it take for you to create your own investment bank? See, that doesn't really work. Because I think it's in the 5,000s, but there's a rule, there's a FINRA rule 5,300, like 36 or something like that. FINRA rule 50, I'll just go 5,300. That would be conflict, broker dealer, investment bank, disclosure. FINRA rule, I'm not going to be able to find it right now. It's in the 5,300 range. But anyway, the FINRA rule requires that if you do a non-accredited round with a company that has a conflict of interest to the mini fund, so to speak, you need, and the broker dealer, then you must disclose the conflict and have an independent investment bank. So there's a problem there. Now we could use a third-party broker dealer and remove some of that conflict. So that's a potential, but you know, then somebody still has to value the real estate. So anything's on the table, but we're trying to do everything we can to reduce costs. Again, why I got all the licenses. But creating my own investment bank, that's like not in the near-term horizon of intentions. Good question, though. Yes, if properties are bought with loans, mini funds pay for the loans. Yes, mini funds buy from HouseHack, exactly. Chat GPT, the law. I can tell. I'll tell you what the rule is. I'll pull it up really quick. So let's see. Right now, nobody would lead it the way Kevin would exactly. That's my thought. So it's in the WSPs. Let me go to February. Is it here? WSP. And then open WSP that. Open. There we go. Okay, so this would be investment bank. Let's see. Doing this live is a little tricky. Oh my gosh, I didn't think investment bank was mentioned 93 times in this. Okay, anyway, it's one of those rules. It'll come up. I'll see if I can find it. I'm pretty sure it's in the 5,300 range. But anyway, I can't find it right now, especially not live. But yeah, I thought if I just searched investment bank, I'd find it right away. Never mind. Did I feel an earthquake? I felt nothing. Thank you for your answer. If somebody can do it, you can do it. Thank you for that. That's smart. HouseHack cashless purchase. Yeah, exactly. Exactly, Manuel. Exactly. Manuel, sorry. I'm thinking about FINRA Manual, and I just blended that with your name. My bad. Anyway, that's it. I'm exhausted. Will HouseHack be worth more than Apple and Saudi Aramco combined? Strap question. That makes it seem like your Elon. Is that good or bad? That depends. All right, folks, look. If you have questions at this point, email us at ir@househack.com. If you would like to invest and you don't have your accredited investor ready, invest ready letter yet, your CPA letter or whatever, you could still sign your subscription agreement today. Best case scenario, you sign your subscription agreement today, you wire your funds today, please do not ACH, and you obviously have read the PPM and the risk disclosures and otherwise. You've done all of that. And so you sign your subscription agreement, read the PPM, and you wire your funds today, and you have your accredited investor letter. That's best case scenario. It's 2 p.m. already. It's already past the wire time frame. So that's impossible at this point, unless you've already wired. So what's the next best thing? You sign your subscription agreement before midnight tonight. So you go to househack.com/2024. We'll do it right now. househack.com/2024. This is where you get lots of answers. This is where you could join me on the roadshow in San Diego or Long Beach today. This is how you could get your accredited investor letter. This is where you could download the investor presentation. This is where you could download the PPM. See, look, here's the investor presentation. Yay, pretty. Here's the PPM. Ooh, not pretty. This is very important though. This is the solicitation. The video is not. The brochure is not. This is. Okay, then you can click invest now. This right here, that's not supposed to be pressure language, mind you. SEC, no, there's no pressure. You must not do this. This is your choice. But then you could fill out this information. If you don't have your letter yet, just upload like some blank document as a place filler. But then you can go through the DocuSign. We'll fix it all after. We'll help you get it fixed in email. Give us some time, obviously. But yes, the round closes today at 11:59 p.m. Pacific time. So make sure you, at the very least, complete that DocuSign before then. If there are issues, we will fix it afterwards. All right. That was very good. We finished J-Powell like an hour and 40 minutes ago. So that's been a lot. Will HouseHack shares be worth more than Wings? I hope so. I'm so tired of that company. If coming into a DST from cash or IRA, switching to another DST would cause... Yes. Yes. If you went from like our DST to a different DST, yes. Obviously, you're going to pay whatever their fee is, right? I own profitable single-family rentals. Let's see here. In the U.S., is holding property more advantageous if corps continue to eat up the segment of the market? Well, I mean, the more demand there is for real estate, the more you're probably going to see prices move up, especially in areas like California, where you have, in California, you've got a political environment that is very anti-building homes, but they want affordable housing, which seems like cognitive dissonance. Like, how does that make sense, right? I don't, what do I know? But, yeah. Good question. So, thank you. SEC is always in the room, as they should be. I don't disrespect the SEC. I actually think Elon sometimes is too disrespectful to the SEC. I know they make mistakes. Obviously I think they've made mistakes with crypto, but I actually don't mind FINRA and the SEC. I think if you do the right thing, you have nothing to fear. That's not always true, obviously. Obviously with some of the stuff you've seen with crypto, but I'm glad that they're going in the direction of now, like approving the Bitcoin ETFs and growing from there. So there you go. So thank you. Thank you all so much. I should press this button. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. That's funny. The market tanked into the close. Look at that. All of the trading bets went in. Market closed. That's actually funny. I got to send out that alert, but I actually set some buys in the fund it's called market on close, and when you buy in a fund, you could set the purchase moment could be whatever the market price is at the close of the day. And so I put some market on close orders in, and that's really funny because that means as long as those went through, I was live during that time, but as long as those went through, the pricing of that would have been right at the close, which is funny because it means that was the lower point. All right. Anyway, thanks so much for being here. See you in the next one. Goodbye. Good luck.